0.2%. And the finance minister, Suzuki, again, he's closely watching. That's the trigger word for potential.
Closely watching. I love economics where we talk about closely watching being the trigger words.
Listen, well, I tell you what, when they ring you and they said you want to go to Japan and cover the Bank of Japan, you know, for a nice long trip, you won't be saying it in that tone. You go, yes, I'm off to Tokyo, because the whole world seems to be either bail in and buy Japan. As put your money anywhere else apart from China and Asia, and it seems to be the destination is Japan.
Thank you, Warren Buffett.
Thank you very much. Let's buy the brokerages companies. Let's talk about under surveillance this morning. This is what we've got for you. We've talked about it all week. Spirit Airlines, they're downplaying speculation that it's planning a bankruptcy-driven restructuring, saying in a statement, quote, Spirit is not pursuing nor involved in a statutory restructuring. However, Reuters reporting that Spirit is pushing JetBlue to appeal the decision, blocking the planned sale. JetBlue has yet to respond. Spirit is re-examining its balance sheet after the U.S. district judge sided with the antitrust regulator, saying the deal would lead to higher fares. Tier 2 airlines, the whole point where I come from in Europe and in the Middle East, it is about consolidation because those low-cost air carriers had to consolidate in a post-COVID world for efficiency. All hail Michael O'Leary at Ryanair.
And of course, when it comes to JetBlue, it needed capacity, and by buying Spirit Airways, that would be one way to solve that problem, because ordering planes from Boeing would take years and years before it actually comes to fruition. JetBlue, Spirit stock has fallen about 62% this week on this DOJ pushback, this DOJ blocking the merger. But if you look at JetBlue stock, it's up about 3.3%. So I don't know that it's motivated, to necessarily go appeal that ruling.
Look, I think when you look at the debt structure, and we'll move on in just a moment, Citi downgraded Spirit to a sell from neutral because $3.3 billion, that's what the debt level was just a couple of years, to $5.5 billion. That's the noose around their neck. Can you refinance your debt? And if you can, then good luck to you. Let's move along. YouTube, Spotify, they're following Netflix in snubbing Apple's Vision Pro, announcing they will not launch the app for the tech giant's mixed reality headset. This is all, of course, about Vision Pro. It's available, pre-orders starting today, giving Apple its first real taste of consumer demand for a device over $3,000.
$3,499.
I knew you were going to do that.
Yeah, I mean, over $3,000 doesn't really tell you how expensive it is.
Amy, that's another $500 on the price. You know, every $500. That's the producer of this show. There's a $500 top up there. This takes me back to when you got your first mobile phone. You went, oh, that's so expensive. Would I spend that on a mobile phone? And then the commoditization of that. But this is about snubbing Apple, isn't it?
This is about snubbing Apple. You know who is taking part? Disney Plus, Max, Peacock, ESPN, and Amazon Prime. So all the streamers that are busy fighting for market share, they've bought in. They're going to launch new apps for the Vision Pro's operating system. What YouTube, Spotify, Netflix all say is that, oh, you can use our service through the Safari app on the device. So you can get to us in a roundabout way. We're just not going to bother with coming up with the technology right now for you to launch into us right away.
And of course, they go on sale today, the pre-orders. So I think the numbers are 300 to 400. Do that again. Slow down. 300 to 400,000 units this year, generating $1.4 billion. I don't want to spend $3,500 on a headset.
No. You wonder if it's going to be like the Apple Watch, where there's a lot of fanfare, because with every Apple launch, there's a lot of fanfare, and then it kind of takes a slow build to get to some point where there's momentum for enough other people to want to get in on it.
Geopolitics, never far from the show's attention. Houthi militants in Yemen firing missiles at another U.S.-owned ship in the Red Sea. This is the third such attack in 3 days, and President Biden acknowledging U.S. airstrikes have not halted the attack, saying, quote, they are stopping. Are they stopping the Houthis? No. Are they going to continue? Yes. And then we had this statement slightly walked back by the State Department, which is, that's a tacit admission that what I'm doing is not going to have a major impact. But I think it does show the distance between verbiage from the UK and the US. David Cameron was in surveillance in Davos saying, we warned them, we warned them, we warned them. And finally, we took action. And Biden reaffirms there will be more.
Yeah, well, I mean, the White House, the UK, between a rock and a hard place here. It's very difficult to move forward on this. There's so many different moving parts, and the Houthis are incentivized to continue doing this. We know the White House has now placed the Houthis back on the global terrorism list to blunt that group's ability to raise funds. And of course, it was President Biden who had removed the designation a few years ago to ensure that they would have access to humanitarian aid following years of civil war in Yemen.
Okay, well, let's talk about the U.S. economy, because defense is a core part of that economy. To Lindsay Piegza, she joins us now with the very latest views on the U.S. Lindsay, good to have you with us. I look at this week and I keep getting smacked in the head by retail sales, jobless claims, the lowest in a couple of years. This is a strong consumer. This is a strong U.S. economy. But is there anything in the soft data, is there anything out there that says to you, Manus, I think it's not as robust as you all think at the end of this week?
Well, I think at this point, the U.S. economy is faring quite well. We continue to see, as you mentioned, a very resilient consumer. So we do expect growth to remain positive as we look further out into the new year, but at a slightly reduced pace, certainly from that outsized rise that we saw in the third quarter. As we await the final print of Q4, likely half what we saw in the third quarter, before growth slows further to about a 1.5–2% average annual pace in the new year. So consumers are still spending, businesses are still investing, but it's also clear that there's a loss of momentum. There's a sense of fatigue setting in that, again, will keep growth positive, but also positive at a slower pace throughout the new year.
Right, and the consensus estimate right now for that fourth quarter GDP print that is coming out on the 25th is for 1.9%. That would be a dramatic slowdown from the 4.9% that we got in the third quarter. So, Lindsay, as you wait to hear the earnings comments from the different CEOs, I'm wondering what you're gleaning, certainly from the big banks, in terms of the spending environment, the demand environment.
Well, when we look at the household balance sheet, what's very clear is there's still a lot of borrowing power. There's still a lot of spending and investment power from the side of the consumer. And so I would expect, again, the consumer to continue to support growth going forward into the new year. This willingness to spend dollars, ramp up debt. We've seen the consumer find additional factors to support that loss of earlier fiscal and other pandemic supports. We've seen a turning to 401ks, hardship withdrawals up double digits. This reliance on generational wealth transfers, and of course, consumers turning to credit card debt, with that outstanding balance pushing well over 1.1 trillion at this point. So consumers do have access to other funds, and they're going to continue to spend those funds as long as they're available.
Right, that's the one consistent thing about the U.S. consumer. They will continue to spend, and that's something Manus and I were joking about. How does this affect their perception, American consumers' perception of current conditions and where they see prices? We've got University of Michigan numbers coming out at 10 a.m. And of course, one of the points that everyone looks at is the one-year inflation outlook and the 5 to 10-year inflation outlook. I think it's difficult to figure out what inflation is going to do later on this year, let alone in 1 year's time or 5 to 10 years' time.
Oh, absolutely. Well, the consumer right now is feeling relatively firm. They're feeling relatively solid because they do have access to these additional funds, and they're not necessarily feeling that threat of falling off a cliff. That being said, higher borrowing costs, elevated prices, this is compounding the weight on the average consumer, and consumers are feeling that. Remember, price pressures are slowing, but nominally prices are still rising. So consumers are having to shift and just make decisions about those purchases on a month-to-month basis, and this is weighing on their not only ability to spend, but their willingness to spend, as well as their expectations for future prices as we look out into the future.
And there's a real bifurcation out there. You speak to the Carnival CEO, you speak to the Moët Hennessy CEO, and they're telling you that there is no slowdown in demand for cruises, for champagne, for high-end wine. So I think there is a bifurcation in the consumer, and we need to remember that in terms of the kind of CEOs that we talk to. What I am curious to know is this. We have been told this week very, very clearly by Waller that the cuts will be methodic. They will be cautious. Bostic reaffirms that. I just wonder, we're being told this is not GFC, this is not pandemic, this is not taper tantrum land. So the cadence of these rate cuts, we really do need to recalibrate. Do you think we've recalibrated sufficiently? And what speed and scale do you think we will get 2024, 2025? Nobody's talking about 2025. So put it together for me.
No, I think the market is still very much ahead of itself. The Fed has been very clear that they're willing to have the conversation about rate cuts, but the support for initiating those is not unilateral. It has to come with the prerequisite that inflation continues back down to a sustained 2% level. And the data right now does just not support that. And so the notion that the Fed would be willing to engage in rate cuts in the first quarter very much seems unjustified. In fact, looking at the data with growth accelerating beyond earlier expectations, and as we just talked about, a very solid consumer, I think the expectation for even a second quarter cut may be too early to price in. I think the Fed is going to be sitting on the sidelines until the second half of the year with a very tempered pace of reduction. So the market is anticipating 25 basis points a month. I think it's going to be more about 25 basis points a quarter, keeping us well above neutral, to your point, as we look out to 2025 and beyond.
There's also concern that inflation will start to reaccelerate as well. Given the data that we've been seeing from retail sales, from jobless claims, it's clear that the U.S. economy continues to be very resilient. What part of inflation are markets ignoring or overlooking? Mohamed El-Erian was telling Bloomberg that it's in the service sector. We see, of course, oil prices struggling to move above for WTI $75, but if it does get there and blows through, that could be another source of inflation.
That's right. Goods inflation has come down precipitously, and in some cases, we have seen outright deflation. But it's the service side of the equation that continues to be a problem for the Fed, particularly when we look at the underlying component of wage inflation or wage pressures. And so right now, when we look at the unevenness of the data, when we look at the painfully slow pace of disinflation for the overall key metrics of inflation, again, it's not convincing that we're on a sustainable downward trajectory. The Fed wants to see more evidence, and with a number of risks out there in the marketplace, including geopolitical risks, shipping costs up 130%, which could lead to a spike in goods costs in the mid part of the year, the Fed simply is not willing to begin to unwind all of the work they've done to slow inflation prematurely. So again, the Fed is going to be very patient and likely on the sidelines for significantly longer than the market is anticipating.
It's just unfortunate that the bond traders haven't acquired that sort of patience and sort of deliberation, but maybe they'll be whipped into shape. Lindsay, thank you very much for joining with us. Lindsay PX of Stifel with her views on the markets. We're going to talk about Jamie Dimon's pay rise in a wee minute, aren't we?
Yeah, well, I mean, Lindsay mentioned wage increases. Jamie Dimon got a pay raise, a little bit better than inflation.
35. But of course, it was skewed towards delivering on the incentives.
Deferred compensation, I believe, is the word.
Deferred compensation. Yeah. We've all seen that. Anybody want a snapshot of risk? Let's have a look at this. There you go. Look at that. Rock and roll. Equities, Nasdaq took out high yesterday. SPOs are up 0.5% this morning. We'll risk on for this Friday ahead of the University of Michigan numbers. Coming up, Bloomberg's Lisa Abramovich with the highlights of this week's World Economic Forum from Davos. Good morning.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg's Lisa Abramovich has been in Davos this week speaking to the business and the political leaders from around the world. Lisa, good to see you, and the team looked as if you had a mighty week. If I said to you, how would you encapsulate that week? What would that be? What would define the week of Davos 2024?
Manus, thank you so much. And I will say the one word that would encapsulate 2024, the Davos here, is enthusiasm. Just incredible enthusiasm and optimism from a lot of business executives, which honestly is sometimes you could say they're talking their book. But this time it sounded like they felt the economy was rounding a corner. Take a listen.
The market might be a little bit ahead of itself. I have no doubt that we'll get to rate cuts at some point.
The markets have now priced in what I think is probably excessive interest rate cuts in the U.S.
The market is being aggressive on rate cuts, all right? And I believe that the Fed is going to take its time.
The 6 rate cuts, that's a pipe dream if we have a soft landing. That's not happening.
The market is now calling for a 175 basis point cut by the Fed. Really? How about this? No way. No way at all.
By the end of the year, they will start cutting.
Our core team has 4 cuts, and 4 cuts, 24 and 25.
This basically comes to the fact that if you have this incredible enthusiasm from all of the different business executives, then you end up with a question of why even cut rates, which definitely was one of the big takeaways here from Davos. There's also sort of this geopolitical overhang, especially with these hordes of police officers and snipers on every rooftop to try to protect all of these leaders of different countries that are at war with one another. A real hang here with this question of what will happen, particularly in the Middle East, why there hasn't been a bigger influence on oil prices, really how long it will take before we see that. Take a listen.
The U.S. is pumping more than 13 million barrels of oil per day. Do you think that that's a policy failure or a policy success?
It's a policy necessity because you obviously can't shut down the economies of the world.
We have not made fundamental changes to how we've been moving ships over the last few weeks.
Are you surprised that we haven't seen any influence on prices whatsoever?
I actually am. That's an important part of the world for oil supply, and traditionally, when risks elevate in the Middle East, you see it reflected in markets.
I think it's absolutely vital that we send a very clear and unequivocal message to Iran. This behavior is unacceptable.
2024 will be about throwing Russia from the air, because the one who dominates the air defines the timeline of the war and the terms of peace.
So that was some of the takeaways and some of what we heard over there, Manus and Scarlett. Honestly, it's been a long week. I think everyone's very happy to go home after a week of not a lot of sleep and not a lot of personal time. At the same point, at the same focus, though, it was really productive, and it seemed like a lot of things got done. It was not necessarily highfalutin ideas as much as in practice, what can we get done?
Yeah, I mean, it's interesting there that you've got John Kerry talking about the necessity of oil production. I listened into your conversation with Mike Wirth when you were talking about geopolitical risk in commodity markets, and he was surprised about the lack of geopolitical pricing that was in the oil price at this time, and that is just something that goes on and escalates on a daily basis, doesn't it?
Yeah, it is. And oh, I'm sorry, Lisa, go on.
No, I completely agree with you. And frankly, what Mike Wirth's point was it's because we're having 13 million barrels of oil pumped every single day here in the U.S. The question is, how much more can the U.S. pump? How much is there elasticity there in terms of compensating for further disruption? And, these are some of the conversations at a time where it's not clear how we resolve this. That was really clear to me.
Yeah, especially as the U.S. economy seems to hold up. Demand looking better than expected, certainly a lot better than what a lot of people had anticipated at the end of last year. I wanted to ask you, we know that the Chinese premier kind of gave away the China GDP number at Davos, saying that the economy grew 5.2%. There are a lot of negative headlines when it comes to China's economy overall. Moody's downgrading some Chinese bad banks, of course, and then the stock market tumbling before the national team had to come in and buy. To what extent are people even talking about China the way they once did? Or have the global elite and have markets kind of decoupled themselves from what happens in China?
You know, it's a great question, Scarlett, because I wouldn't say they've decoupled. It's this sort of understanding that it's going to be difficult, and the businesses that need to do business in China will keep doing business in China. Qualcomm CEO came on and was talking about how they plan to continue working with them. They're the world's second biggest economy. That's what you're going to do. On the flip side, what was interesting to me was that China sent their biggest delegation here since 2017. Officials met with a whole host of different business leaders to try to basically convince them that it was safe to come back and invest in China. But there was a resignation among most people that the tensions between the U.S. and China are not going away, that you're going to have a problem going forward just in terms of ongoing divisions. Trip.com CEO came on with us. I thought it was very interesting when she talked about how travel is picking back up and that there is the appetite among Chinese to come to the United States, but they can't because of the visa issue. They're not able to get visas. So, you know, a lot of mixed messages. And I understand there's a talking of a book that I think we have to understand. At the same time, it was just interesting to sort of feel the tension of China present here, but an understanding things have changed.
Yeah, absolutely. And I'm glad you bring up the missing Chinese tourists, because today's big take on the Bloomberg is about China's severed air links draining $130 billion from global tourism. Folks should check that out on the terminal. One thing that you mentioned about rising U.S.-China tensions certainly is that it's been consistent from President Trump's administration through to President Biden's administration. And whatever happens in November, it will continue to be a theme. What are people saying when it comes to the possibility of Trump 2.0?
So we asked a lot of people about this. This was a very hot topic here, and it ranged from a real sense of resignation to frustration to anger to befuddlement to some people just saying, well, you know, he wasn't wrong about certain things. Mark Rutte was talking about that with respect to the NATO spending and European countries really pulling their own weight. The big takeaway, though, I'm glad that you brought that up, Scarlett, this idea of the policies on trade under Trump are not that different as they are under Biden. And so right now, businesses are starting to understand that. The big change with Trump 2.0 is the uncertainty factor, because frankly, that is the sort of hallmark of Donald Trump. It is the unpredictability. And I think that that is really what was hanging over people's heads. Business wants predictability. And that was a big concern for a lot of people here at Davos.
Well, I think the Emmy for dramatic effect goes to Christine Lagarde when she was asked, you know, what was she thinking about in terms of Trump coming back to power? And she just paused. I'll have some coffee.
I would give her the Oscar for that.
You give her an Oscar?
Yeah.
Okay.
The timing was impeccable.
She's front running it. And this is what she said in response to Francine in regards to a second term of Donald Trump being in the White House. She took a slightly more bullish stance. The best defense is a form of attack, and pushing a strengthening of the European Union by creating a single market. I mean, many people will give you lots of responses. We don't know who's going to be on the ticket. We don't know who's going to be in the White House, Lisa. But one thing for sure is we have two hot wars. We have Hamas, Israel, and we have Ukraine. The Ukrainian foreign minister was with you, and I thought it was quite prescient that he said, it's not that they don't want to give us the money, it's that they've got domestic issues that are a higher priority. So this is a critical issue in the world. Did it rate at Davos this year?
You know, it's a good question whether Ukraine really was as present. It certainly wasn't as much as it was last year. Last year, it was very much front and center. A lot of questions about how it would transpire. This year, it was sort of the drumbeat underneath as another one of the hot wars. I think people have perhaps moved on a little bit more than the Ukrainians would like. But I think the fact that President Volodymyr Zelensky was here, meeting with all of the business leaders, shaking the hands of Jamie Dimon, shaking the hands of all the different bank executives. I asked the Ukrainian foreign minister, what do you want with these private executives? What support are you hoping to find? You know, there is this feeling, and I will say, and this is just in anecdotal conversations that I had with business executives in private conversations, there's a feeling that some of the public officials are going to business executives for advice for the first time that they've really ever seen. They want to understand what the business landscape is trying to get to be confident. There is a sense of we don't know what to do among a lot of public officials. And to me, that was really a noteworthy kind of revelation at a time of so much uncertainty.
Lisa, thank you very much. Yeah, it's an interesting moment when you get foreign ministers sitting down with Jamie Dimon looking for advice when political leaders are perhaps less present and available. Lisa, thank you very much. Great coverage. You, the team, Anne-Marie and Jonathan, and of course Francine and Haslinde in Davos. This is Bloomberg.
Later got asked to be the head of USAID.
I got that job when I was 36 years old.
36 years old. You're running USAID. How many employees does it have?
We had 11,000.
And did you feel qualified to run something that big?
I did until, the work started.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships. And you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The new Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto.
There is some reason for optimism. If you look at inflation around the world, it's on a downward glide path.
If you emphasize the word landing more than soft, I think we've achieved it.
We're going to see volatility, but the trajectories are in place for lower rates, for less inflation, but not on an even keel, if you will.
I believe that the Fed is going to take its time, especially without a recession.
They're going to start lowering at some point when they're ready. They're going to be prudent. They're going to be thoughtful.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz.
From New York City. For our audience worldwide, good morning. This is Bloomberg Surveillance. As you can see, it's none of those surveillance folks. It is Manus Cranny and myself. I'm Scarlet Fu. Everyone is recovering from Davos. They're going to be making their way back, but we have plenty of news to keep you occupied with in the meantime. And Manus, we're just looking at the headlines that crossed on Spirit Airlines. We know the DOJ blocked that merger deal, and yet Spirit Airlines, there's some headlines here with Spirit assessing options to refinance its 2025 debt maturities. Yes, we knew that that was an issue, but more relevant to this JetBlue merger is that Spirit Airlines is still saying that the merger agreement remains in full force and effect. They've also given a pre-announcement of their earnings for the fourth quarter. Fourth quarter operating revenue, $1.32 billion, slightly higher than what the consensus estimate was of $1.3 billion. But Spirit still believes JetBlue combination is the best opportunity out there. You could see Spirit Airlines shares moving higher in pre-market trading, up by 12% right now. For the week so far, it's down about 62%. JetBlue, meantime, this week, up about 3%. So you know that JetBlue shareholders are kind of relieved, it seems, that that merger is not going through, or at least the DOJ blocked it.
Well, one man's pain is another man's gain. You know, if if Spirit has those material issues in refinancing their debt or their revolving credit, well, that has inherent risk. I'll just leave that thought there. I'm not going to make any predictions on it. I want to give some context around the debt profile within Spirit. So my understanding of it is this. You've got $1.1 billion worth of loyalty program debt coming due in September 2025. I found a fact. And when I find a fact, I'm a bit dangerous. So that is the one line of debt that's coming maturity in September 2025. On the broader context of what is the debt pile for Spirit, it was downgraded by Citi. So it was Citi's note that gave me this data. They downgraded it to sell from a neutral, and they said that the debt sheet has risen from $3.3 billion to $5.5 billion overall in the past 2 years. So that's the weight of debt that needs to be resolved. Spirit are also saying they have modified the revolving credit line in November. Now, we need to get a little bit more detail on that. The question is, will your credit lines help you through? Can you refinance? What do you pay to refinance? And will you make it through that refinancing wall? And it's not just Spirit that's going to face this.
No, but Spirit is, of course, facing this first. And the big issue with Spirit is that a lot of analysts had anticipated if this deal did not go through, it would have no choice but to potentially file for Chapter 11 bankruptcy protection. Another headline here, going to what you were saying about the debt due, Spirit had $1.3 billion of liquidity as of the end of December last year, and it's taken several steps to shore up its liquidity during the fourth quarter. Of course, we will continue to keep you posted on this. JetBlue has not made a comment on this, and we will bring it to you when that happens. But if we broaden out our look at what's going on in the financial markets right now, you can see U.S. stocks are set to move higher or open higher, and the NASDAQ continues to lead the way. The NASDAQ closed at a record high yesterday, Manus.
Yeah, I mean, so much for the death of Mag 7, so much for breadth. That's just, well, that's 2 weeks ago news, isn't it?
Yeah, the markets have a very short-term memory span.
I mean, there's no doubt about it. Tech is on fire.
Tech is on fire. What's not on fire right now is the pound. You can see it lower by 0.2% at 126.80. We did get a retail sales report that was disappointing. It was actually the worst retail sales report in almost 3 years and does increase the risk of recession. But the flip side to this, of course, Manus, is that the dollar is in resurgence mode this year. It's firmer against all G10 and major currencies. So far this year, Bloomberg Dollar Index up about 2%.
Look, short rates went up by 20 basis points this week. 10 years went up by 20 basis points, moving the dollar higher. Wasn't so much risk. Look, it depends on how you write this story.
Sure.
1 week we're writing a story that is risk off and the dollar is bid. The following week it is, oh, we're risk on, and yields back up and the dollar is bid. Either way, we are up 1%. That king dollar narrative remains very much intact. It's strong. It's up 1% on the week. What would you want as a perfect hedge? I don't know. Volatility is repressed. Do you want the dollar? And yen's not doing its job as the backstop.
Usually when the dollar is higher, we'll see losses in oil. Right now, if you take a look at oil prices, they're holding near a 3-week high. WTI just approaching $75, Brent approaching 80. And of course, we're keeping an eye on all the developments in the Red Sea, the U.S. and the Houthis trading tit-for-tat strikes in that area. Let's bring in now our first guest of the hour, Margie Patel, Senior Portfolio Manager at Allspring Global global investments. And Margie, for years, you were kind of known as a bond expert. And of course, certainly you still are. No one ever stops being a bond expert. But most of your assets that you manage now are equities, 75% right now to be exact. I'm curious to get your take as a former bond person and as a current equities person. Are the bond market and equity market looking at the data and what the Fed does next in different ways?
Well, I think the equity market is looking at the strength of earnings. I think that's number one. And really, rates are so low across the board in treasuries, I would say it's almost irrelevant for corporate planning. And so many corporations raise so much money when we have zero interest rates that what the Fed does is really irrelevant to their operating. So we think there is a little bit of a disconnect, yes.
Okay, so equity investors can key off of earnings and whatever optimistic comments the CEOs are making, while bond investors are obsessed with, and rightly so, with what the Fed does next and how it's signaling what it does next. What is your thinking in terms of rate cuts? Are you on the first half bandwagon, the second half bandwagon?
Well, I think the Fed is searching for relevance to show that it has some ability to affect the economy and financial markets, which it really hasn't very much since they started to raise rates. I think really we'll see rate cuts, maybe one or two, in the second half. I don't see any reason to expect them to act in the first half. But of course, they'll want to be clear of the election. So if they don't act by summer, then they'll really be in a holding pattern until after the election.
And that is the risk. Margie, good morning. Lovely to meet you. You talk about you're not too stressed about whether there's material rate cuts for the corporate balance sheets. But to what extent does the consumer, does Scarlett, myself, the average normal person, need to see rate cuts to underpin our confidence to spend? We've got jobs, we're being paid, but what material difference will those rate cuts make to the consumer equity side of the trade?
Well, actually, I think very little, because we've had the Fed raise rates at historically faster than they ever did, and yet unemployment is very near the lows. And I think what's more important for the consumers is what are their real wages, and it looks as if wages are more or less keeping pace with the stated inflation level. The top, say, 60% of consumers still have some liquidity. They don't need to borrow. It's really the lower tier that are really hurt, and they're a smaller percent of the whole economy. So consumers look pretty decent to me.
With that in mind, then, you know, certain parts of the market have been wrong-footed. There was this narrative, you know, you want to be less long of Mag 7, you want to go for breadth, you want to be a little bit wary on tech, on rising rates. So some of these consensus phrases that we use all the time are being beaten, they're being beaten back. When you look at the earnings sheet, where am I going to see the strongest earnings growth?
Well, I think the trends that we saw last year are still going to be in place. So that says to me we're going to see a small number of leaders in the marketplace, as we did last year. I think tech is going to continue to have relative strength compared to many other sectors, especially with an economic growth that I think will be more or less modest. So we think tech will do well. Certain industrials that have a lot of capital expenditure attachments, and maybe even healthcare might be near turning around from a bottom and doing a little better in the second half of the year.
So tell me then, when you see big notes come out against big names, like Apple had 3 downgrades, 1 upgrade, and they've got a few issues around some software, etc. When you see significant repricing in any of those really high-end Mag 7 and perhaps even just a slightly broader church than that, do you see that as a re-entry point? Is it a buy the dip mentality that you're going to adopt when you see moments appear in the Mag 7?
Well, I think really we may see those Magnificent 7 go their own way. And again, the reason they've been magnificent is they've had better earnings growth than most of the other sectors. And so if we see a particular company, say Apple, having more decelerated earnings, we may see them not really part of the group because they simply don't have the growth that the other, say, 6 still have. So it's really, I think, going to be fundamentals whether they still maintain their lead.
It's going to be fundamentally driven, which brings us to the tech earnings. We'll, of course, hear from Netflix. And even though Netflix's business model is different from the other Mag 7 companies, certainly it sets the tone for those companies involved in streaming. Are we going to get another year of efficiency kind of theme from these big tech companies, which, of course, cut a lot of costs in 2023 and slimmed things down to boost their margins?
Yes, I still think they're going to be one of the fastest growing sectors. And I think it's because simply these big moves, artificial intelligence, more move to the clouds, that kind of thing, I think is still going to be in place. And that's going to keep those companies having way above average growth rates compared to other sectors. It's not what a lot of people would like to see. So this big broadening out, I think, is going to be rather limited, just as it was last year.
Okay, and we're talking about workforce consolidation. Wayfair, the furniture retailer, has announced a workforce realignment plan. There's some marketing buzzwords. It's going to lay off about 13% of its workforce. The workforce reduction involves about 1,650 employees, Manus, with an annualized cost savings of more than $280 million. And you can see their Wayfair shares moving up in the pre-market right now by 11%. But of course, volume can be limited in these instances in pre-market trading. Margie, I want to come to you on deal making because Lisa Bromwitz and the surveillance team have been in Davos. There's been a lot of talk about lower rates being a good lubricant for M&A this year. And there's a lot of optimism about a lot of that happening. We got headlines this morning from Spirit Airlines saying that the JetBlue merger agreement remains in full force and effect even after the DOJ blocked it. And we were talking about how this creates a conundrum for these second-tier companies, airlines in this case, on how they move forward when they don't have the scale, they don't have the balance sheet to necessarily do that in the face of a government that doesn't want to reduce competition. What does a second-tier company like Spirit Airlines do? How are you thinking through M&A in 2024 when there is so much government pushback, yet you've got the tailwind of lower rates?
Well, I think looking at M&A, I think that what you often see is the best companies are acquired, the smaller companies or specialty companies acquired by larger companies. And typically, we don't see the weaker companies being acquired. Those are really the kind of things that you see more M&A in private equity, where they just look at the spread and the cash flow and will have a better bid than larger companies looking for a strategic addition to their corporate earnings.
All right, Margie, really appreciate your joining us today. Margie Patel of Allspring Global Investments. 75% of the assets that she manages are in equities, and of course, she's still exposed to bonds. And Manus, I look at the Spirit Airlines and the JetBlue Airways merger that is still on, according to Spirit. Interesting development given the opposition, the hard opposition from U.S. regulators and a court decision.
Yeah, and actually they say that there is a line there that the merger still remains in full effect, even though you've had that judgment against it. Now, we've just seen JetBlue open up 1%. So this is going to be a tussle through the morning. Can they refinance? How much will they refinance? And what will the demand be for the debt? And this was something that we talked a lot about in October and November. Remember the wall of maturity, which never really came to pass. You've just heard from Margie there talking about a lot of corporates, and this is a theme that we've touched on, a lot of corporates have already refinanced. A lot of people have refinanced. I mean, I can't get a mortgage yet.
But all the people with their sub 3% mortgages.
Have you got a sub 3% mortgage? Are you going to turn me green with envy now?
Yeah, no, I do. But then also I'm locked into it. I can never do anything.
Can I just tell you, in the UK, I have a mortgage at LIBOR. That's a thing that you all remember. LIBOR. LIBOR plus
Here's a
an
blast
eighth.
from the past.
Never in the history of money will you get a mortgage at LIBOR plus an eighth. I can't say which institution sold it to me. They were good.
All right, we've got much more coming up. Maya McGinnis of the Committee for a Responsible Federal Budget is our guest next. This is Surveillance on Bloomberg.
politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world starting Monday. Every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. The 2024 nominating contests are here, and the candidates are making their cases to New Hampshire voters ahead of the primary.
And we're off to New Hampshire.
Bloomberg is live in the ground, bringing you the fastest news,
Trump is leading by a long shot.
insightful interviews,
And at the end of the day, that's what the American people want.
and the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
It all starts Monday in New Hampshire, only on Bloomberg.
Ukraine does not steal any money from American taxpayers. It's, to say the least, a very little part of the overall defense spendings. Moreover, a vast amount of this money stays in the United States because it's invested in the production of weapons that goes then to Ukraine, and it needs to be explained to American taxpayers that their communities benefit from it. The new jobs are created.
That was the Ukraine foreign minister, of course, Ukraine officials in Davos making their appeal to U.S. leaders, the global elite, and of course U.S. taxpayers to send some aid their way. When we take a look at what's going on in the markets right now, it's been a while since the Ukraine war has affected markets. What is affecting markets, certainly for crude oil, and you'd be surprised that it isn't affecting it more, is the tit-for-tat strikes, missile strikes in the Red Sea.
Look, I think when it comes to the oil market, it's about the oversupply. The exports from Russia are on the rise. The demand level is firm, but the supply level, you heard the conversation with John Kerry and Lisa talking about the U.S. producing 13 million barrels a day of oil, but in terms of total production from this country, it's over 21 million barrels. That's gas and oil and all compilated together.
Yeah.
So the quantum, this scale of supply from this country onto the global market is in many ways what's creating that cap. And then, of course, the Russians, part of OPEC Plus, they are pumping like Billy. They're exporting like
Yes,
Billy.
yes.
Excuse me, there's a qualification.
No, they're exporting, and of course, demand hasn't been as strong as you might have expected from the likes of China, which would tend to absorb a lot of that extra supply, but that's not happening right now with that economy struggling at this point. When it comes to futures, we're looking at gains for U.S. stocks heading into the open, and the 10-year yield not doing a whole lot right now, Manus, but it's had a pretty big week. You talk about a 21 basis point move for the 10-year yield. Currently, no change.
Yeah, there you go. I mean, short end of the curve, 20 basis points on it. Long end of the curve, 20 basis points on it. The question now is, do we flick to steepeners? If this U.S. economy is firm, robust, firing on many cylinders, the consumer is strong, the consumer is healthy, part of the consumer, by the way, I'm now part of it. But this is the point.
You're not part of it?
I am.
You
are. I went and spent a few dollars at Christmas time. Mohammed El-Arian makes this point. Multi-faith in the retail. El-Arian says the markets have overpriced the speed and the depth of Fed cuts, and he wouldn't be surprised if they only start in the summer. That's in his story this morning on Bloomberg.
Yeah, and of course, markets have been pricing in anywhere from 5 to 6 rate cuts for a while now, whereas the Fed itself sees more like 3. All right, let's bring this all together now and bring in Maya McGinnis. She is president of the Committee for a Responsible Federal Budget. And Maya, we did have Congress actually get to work and do something. They've managed to avoid a shutdown. They've passed some bills that President Biden has to sign, but that would allow us to stay funded until March 1st or March 8th. Does Congress get anything done between now and March 1st and March 8th beyond negotiate the same things that they can't agree on?
Yeah, it's a great question. So the starting point is great, good news. We're not shut down, but no one would make the case that Washington is functioning, not by any account. And so between this continuing resolution and the previous one, basically no real progress was made on actually passing appropriation bills, those things that fund the government that should have been done by the end of the fiscal year at the end of September. And there's no reason to think that there's going to be massive progress over the next 6 weeks. I hope there will be, but there could have been for the past 6 weeks. And so the real concern is if we're limping along from one almost crisis to the next, when does anybody kind of settle in and do the work of appropriating or funding the government, or more broadly, creating the actual budgets that guide the government? Keep in mind, last year, the Senate Budget Committee didn't even bother to suggest a budget. It's as though this is all pretend at this point. And so there's clearly the need for a big overhaul in how we budget.
Yeah, absolutely. I mean, I guess the concern now, and maybe it's not even a concern, it's really just expected reality, is that we're going to kind of lurch from short-term spending bill to short-term spending bill, creating this nonstop cycle, and we can't plan for anything, let alone something like figuring out aid to Ukraine or Israel.
No, that's right. Lurching is the word of exactly what's going on. And meanwhile, the question is politically what's going to happen? How will this affect the speaker? Who's going to vote for what? But no real focus is, there's no space for real focus on strategically what should we be doing in terms of budgeting. Keep in mind, a budget is a statement of a country's values and priorities. It really is an important governing document. So much is going on in the world. The geopolitical situation has changed massively. Our big programs, Social Security and Medicare, are headed towards insolvency. If ever there were a moment to say, what are our priorities and how do we want to fund them, that would be where we are now. But instead, it is that lurching. And if we end up just funding the government kind of at flat levels or possibly a small cut because there's a default cut that will go in place, none of the decisions about what makes sense to fund and what should we get rid of will have been addressed. And all of this is with the backdrop that this budget that we don't have only focuses on 1/3 of the government. 2/3 of it are on automatic pilot programs that are growing faster than the economy, and they're getting no attention as well. So while we have these huge issues of the supplementals, Ukraine, Israel, we need to really think, what are our priorities? This stuff isn't going to be just for this year. This is going to be ongoing. How are we going to handle it?
So, Maya, for an Irishman transplanted from the Middle East that grew up in the United Kingdom, your politics makes the Brits look like a walk in the park. I gotta hand it to you. I don't get to vote, so a lot of our viewers will be happy to know that. But what goes through my mind is, what gets Washington to wake up and actually realize, you're living on, as the French finance minister, Valéry Giscard d'Estaing, said, the United States has an exorbitant privilege. So what is it that gets Washington to wake it up? What do you need? A downgrade? Do you need a buyer's strike on your debt? What is it gets politics to wake it up and go, actually, we got to run a country?
Well, so one of the quotes I most live by is from our co-chair, Leon Panetta, who has always said, listen, this is going to happen. Fiscal change is going to have to happen. It will either come from leadership or crisis. And I have always believed it would be from leadership. And I am starting to really believe it's going to only be from a crisis, that nothing else will cause us to act. And then the question is, what crisis will that be? The downgrades should have been wake-up calls. I will add a new problem into how we are budgeting these days, which is there are now many policy problems that we know we need to address, whether it's Social Security or the border. Take your pick. And yet you have politicians from both parties actually making the case, don't solve these issues, even if there's a possible compromise to be had, because we want to keep them alive to fight politically. And I say this as a diehard political independent, but when you are running a country with two parties more intent on killing each other than actually running the country, you have a lot of problems. And I think we're stuck there with these huge levels of polarization.
So Maya, very quickly here, all this talk about business lobbyists pushing for some kind of bipartisan tax deal this year, that's just a pipe dream at this point?
Actually, I don't think so. I think there's a chance that the tax deal that's on the table will move forward. There's been a lot of good work done on it. When I look at it from the perspective of a fiscal hawk, it's actually intended to be offset, gets a lot of credit for that. The policies are temporary, and temporary policies make no sense. They create cliffs. If you look at the longer term cost, it's still very expensive over time and not fully paid for. But the attempt to pay for it in the short run, I think, is important and credible. But I will say, I don't think we should have big tax cuts on the table until we've passed a budget and until we've figured out how to deal with the overall debt situation. Because even if we pay for it, those pay-fors might be better used to get our debt back on a sustainable trajectory. That said, everybody likes tax cuts, and I think there actually is a chance that this bipartisan tax cut will move forward.
Well, it is an election year after all, so there's that to keep in mind. Maya McGinnis of the Committee for a Responsible Federal Budget, thank you very much. Fancy that. Tax cuts going through because both parties want to win re-election. And forget about the long-term plans, you know, the sequencing of how you figure out how much money you have.
The capacity to think long-term, do they?
No. It's in 2-year increments, especially if you're in the House.
Yeah, but I mean, I think that's the global thing. The deficit at the moment, by the way, $510 billion, and 21% of that is to do with interest.
Yeah, paying the interest, and of course, it's only gone up. All right. Coming up next, speaking of interest, we're going to speak with Tony Crescenzi of PIMCO, Bond Guru. This is Surveillance on Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
Connection lost. So I don't think I'm right on this, but this is, my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
morning. This is Bloomberg Surveillance alongside Manus Cranny. I'm Scarlett Fu. Team Surveillance, of course, is in Davos, Switzerland, attending the World Economic Forum. In their place, we are taking a look at futures right now, indicating a higher open for U.S. stocks in about 2 hours' time. You can see S&P futures up 0.4%. NASDAQ 100 at least made a record high yesterday, and right now you can see is leading the way among the futures indexes, up by 2/3%. And the laggard here continues to be the small cap index. The Russell 2000 is higher right now, futures that is, by 0.2%. But what happened to the whole, market breadth is going to come back in 2024?
Yeah, everybody just sort of got off that bus and just went, you know what? I mean, there's a couple of phrases I've learned since I've been on this show. One is, weaponized FOMO. One is JOMO. And what is that?
JOMO?
The joy of missing out. But what we've got now is weaponized FOMO for Mag 7, because as for breadth was this narrative for the first couple of weeks of the year, and everyone, you know what, this bus is left and I'm not on it. So it's like,
Let me get back on the MAGA bus. The Mag 7 bus.
Oh,
MAGA bus is a whole different thing.
MAGA bus is a whole other thing.
Yeah.
A little bit of Mag 7, you can't go wrong, can you? Well,
No.
we'll see how that plays out for the rest of the year.
How
You
are
say
bonds
that now.
looking?
Hey?
How are bonds looking?
Bonds are looking frisky. You've got Waller and Bostic just saying, back it up, boys and girls. You've all got far, far too presumptuous. Mohammed El-Arian endorses that view. Twos flew higher by 21 basis points this week. We gave a pip back this morning. Tens likewise. There is this building narrative, soft landing, strong consumers, strong USA economy. Why is the yield curve not flipping around from inversion to a steepener? But we can debate that with our PIMCO guest in just a moment. But this was a virulent week for bonds, and the equity markets in tech just said, nah, we're not bothered. You know what? We're just going to go long.
We're just going to go long. By the way, no economic data at 8:30 a.m. this morning. We don't get data until 10 a.m. after the market opens. And very quickly here, just taking a look at oil climbing from a 3-week high. And of course, the escalating tensions in the Middle East continue to keep us on notice. All right, under surveillance this morning, the CEO of JP Morgan, Jamie Dimon, getting a pay raise as the bank posts the highest annual profit in the history of American banking. Now, according to regulatory filings, Manus, Dimon was paid $36 million in 2023. That is up from $34.5 million a year earlier. For anyone keeping count, that's a 4.3% increase. You can compare that to your own salary increase that you might have gotten or might not have gotten.
Have you filled in your eval yet?
I have not done that yet.
We have the Bloomberg eval period. The question is, 4.3% sounds quite reasonable in the inflationary environment, but of course it's about delivery. It's about shareholder equity delivery. They pulled in $49.6 billion last year. But there was something for everybody. Daniel Pinto got $30 million.
Yeah.
Mary Erdoes, she got $27 million. She's the global head of wealth management. So it wasn't just for, the Don Juan of Wall Street. Everybody got a little bit of pie at JP Morgan.
Yeah, by the way, those raises, Dan Pinto and Mary Erdoes, raises of at least 5%.
Yeah.
Of course, in coming days, we're going to hear from, we'll get filings of how the other big banks are paying their CEOs, and we'll bring that to you when it comes. The one thing, of course, when it comes to Jamie Dimon and any conversation about him is what's going to happen next. He's been atop the JP Morgan management chain for 18 years now. He has the longest tenure of any big bank CEO. Is he going to step down anytime soon? Whenever you ask him that, he says, ask me in 5 years.
Well, we desperately tried to get him to answer the question, would he run for president of the United States of America? And he sort of swerved that so elegantly. Look, you look at the comeback of Sergio Amotti back to UBS. There is an enduring sense of, support when you see the figurehead at the top of these banks enduring for a long period of time. Brian Moynihan, Sergio Amotti coming back. You have Jamie Dimon there. You know and understand what it is their policies are. One is about a real determination on dividends and return on equity. And Amotti will deliver, we believe, a review on those targets in 10 days' time on his numbers at UBS. Of course, they want to be the Morgan Stanley JPM of the United States of America. Good morning, Sergio.
Good morning, Sergio. All right, let's move from the big banks to the big retailers, because Macy's is cutting staff and it's closing stores. The department store chain says about 2,300 employees will be let go, mostly in corporate roles. 5 stores will also be shut down. According to Macy's, the moves will help it become a more streamlined company, corporate speak. We also know that in terms of timing, this comes as the PE firms Arkhouse Capital and Brigade Capital have made a $5.8 billion offer to take it private. And there's going to be a management change over at Macy's too, right? Because the CEO, Jeff Jeanette, is retiring in February and making way for the president, Tony Spring, to succeed him.
Look, this is all about structural change. We've talked about it ad nauseum for the past 5-10 years in the ever escalating onslaught of Amazon in your life and other delivery mechanisms to you for shopping at the high end, at luxury end, and that's only in its infancy. So this is more about how do we actually transact, how do we buy, and do you want that level of real estate? This goes back also to a whole much broader conversation about commercial real estate as well, not just in retail, but on a U.S. and on a global basis.
Yeah, speaking of commercial real estate, you've gone to the Bloomingdale's right next door to the Bloomberg office, right?
I'm a keen shopper there.
Yeah, that's some prime real estate right there in Midtown East. All right, our final story that we're focusing on right now is Congress averting a partial government shutdown that was set for this weekend, with both chambers, yes, the Senate and the House, passing a short-term spending bill yesterday that pushes new deadlines to March 1st and March 8th. So we get a reprieve, but not for very long. President Joe Biden expected to sign the legislation, which, interestingly enough, in the House, nearly half of the Republicans opposed.
They opposed it. Yeah, and the question is, Mike Johnson, I think we had a conversation a little bit earlier in terms of, he has put himself on a sticky wicket because he promised no more temporary extensions. Here he is, he's just acquiesced to a temporary extension. The House Freedom Caucus have got form in having retribution, don't they?
I'm just still stuck on sticky wicket. What is that?
A sticky wicket. It's, well, first of all, for an Irishman talking about cricket terminology is always dangerous. So sticky wicket is where the wicket sits on the top of the stumps. You're going to help me now in a minute, aren't you?
I know everything about it.
Yeah, okay. The sticky wicket, it just wobbles. But it doesn't quite fall. So all the Brits out there, they can send in a correction on that. Thank you very much.
All right. We were talking to Tony Crescenzi, who's been sitting by patiently. He is PIMCO portfolio manager and member of the firm's investment committee. Tony, it's so great to see you. Thank you for making it in on this freezing morning in New York. Does the move by Congress to actually pass a short-term spending bill and avert a shutdown do anything for the bond market?
I think the bond market coming into 2024 had very little expectation that anything would change regarding the trajectory for U.S. debt. In fact, it hasn't changed in quite a long number of years. I would say, though, that in 2025, we may begin to see what I would call a read my lips moment. Read my lips for George Bush, 1988 presidential candidate, in a speech written by Peggy Noonan, who was a famous speechwriter for Ronald Reagan. In what she said was the best line of the convention, George Bush said, "Read my lips, no new taxes." He wound up breaking that pledge 2 years later because the interest payments on the U.S. debt had grown substantially to a record high, 3.2% of U.S. GDP. That's a level that hasn't been breached since. Today it's at about 2.5%. It's doubled in the last few years because of high indebtedness and high interest rates. It's going to breach the George Bush number in a few years' time. Interest payments will be over $1 trillion, more than defense spending. Then the bond market will begin to say, and investors will begin to say, and the public will begin to say, what's happening here? We can't take much more debt, just like in the UK a year and a half ago when Prime Minister Truss was pressured out, in part because she had a debt proposal that the bond market rejected.
Can you honestly, I mean, everybody sort of smacks me back when I say this, can you imagine some kind of a serious jolt and strike against U.S. Treasuries, as happened under the Truss government?
Well, the way it would likely play out is, as it did under the Truss government, is where the bond market would react to proposals to raise indebtedness further in a very negative way, meaning interest rates would rise, but that rise in interest rates would stop the legislative process in its tracks and prevent the indebtedness from worsening. So I wouldn't worry about it too much, but we would expect some volatility if there are any proposals to raise indebtedness significantly more, because think about it. We are reaching certain endpoints. You could say, I'll call it a Keynesian endpoint.
It's the title of your last book, one of your last books, The Keynesian Endpoint. You said that in the break. Where do we get to in that?
What's a practical limit to the use of debt? We had a lot of spending after the pandemic and inflation that resulted from it. So that's a practical limit. So the bond market, it would be self-stabilizing. In other words, don't worry too much.
All right. So the bond vigilantes will at some point make their presence be known.
They're in control.
They haven't gone to sleep.
Policymakers.
They're just kind of quiet right now.
Because this is an election year, nothing will happen on the legislative process to stop the debt trajectory.
Okay, well, this is an election year. What's going to happen on the Fed front? Because if the Fed moves too close to November, they're going to be accused of trying to influence the election one way or another. So markets are betting that, okay, it's got to happen in the first half. And once it starts, it can't stop.
Well, you've seen some pushback by Fed members recently, including Governor Waller recently, seeming to indicate that the rate cut trajectory that the market thinks is probably a bit sooner and deeper, as Mohamed El-Arian, my former boss, said this morning. The markets may be a bit ahead of themselves. The Fed may achieve price stability before it achieves its inflation objective, the two distinctly different things. And markets will begin to, probably in 2025 and 26, be comfortable with the idea of price stability. What I mean by that is something that Alan Greenspan, the former Fed chair, and Paul Volcker used to define it as a level of price changes that ceases to influence businesses and household decision making. So we may not get to 2.0%, we'll get to 2 point something, but that 2 point something, if it sort of wavers around there, can still be price stability. But the Fed isn't there yet, so it has to be cautious about acting too soon, because a key lesson of history is to keep at it, as Paul Volcker said, and keeping at it is his book from 2018, until the job is done.
I think part of the problem is that we have recency bias. In other words, we're not going to have a cutting cycle that we had in GFC, pandemic, taper tantrum, and others, and we have a community that has lived, perhaps not back past 2000 in this bond market for a long period of time. You said there's 3 Ds. Don't try and time, the bond market. Don't catch a falling knife, but do catch today's yields. So this is rich enough for you on 10s. This is rich enough. Will the curve shift? Do you want to level into this? Do you want to scale into this?
Yeah, so timing moves in interest rates in terms of picking the top in yield is difficult. And lately, yields have been rising. You see the 10-year yield moving from around 3 3/4 to about 4.15 recently. So some investors are probably thinking, maybe I'll wait a little longer, it'll go back to 5%. But that timing decision, many investors historically are poor at it. And today's yields, as I said, so maybe you're worried about catching a falling knife, falling bond prices. So watch your scaling, but do catch these yields while you can, because look at the Bloomberg aggregate real quick. 4 3/4% today. The Bloomberg aggregate, by the way, is sort of like the S&P 500 of bonds, a compilation of high-quality bonds. 4 3/4% is still significantly above the last decade, when it was 2.5. In the last 20 years, it was 3 1/4. In the last 30 years, it was 4 1/2. So you're getting yields above each of those long averages. Yeah. And so quite attractive relative to history, relative to expected inflation in the 2s. So you're getting a high real interest rate. And finally, expected volatility. That Bloomberg aggregate tends to move 2-3% or so. Yes, it moved a lot in 2022, but the bond market's going to say no to inflation, et cetera, and the Fed will get the job done. So, man, it's the final don't for the years. Don't fight the Fed. Believe in its ability to foster price stability.
To execute.
That should give you confidence in owning bonds today. And so we'd have all that confidence. And again, this is a very good time to be investing in fixed income.
All right, Tony Crescenzi with the 3 do's and don'ts when it comes to bonds. Thank you so much for joining us.
Thanks, man. It's great.
Really appreciate you joining us. All right, we do have some breaking news here out of Ford. It is cutting its F-150 EV Lightning production. The stock is moving lower in pre-market trading, off by 0.8%. It is reducing production of this vehicle. About 1,400 employees will be impacted, and it sees global electric vehicle sales growth in 2024. Surprisingly, or I should say not surprisingly, given the headlines here, less than anticipated.
This is actually a much bigger and broader conversation than the idiosyncrasies of Ford. Ford down 0.8%. This is about global demand for EVs. This is about Tesla has had problems. They've been consistently cutting prices in China. This isn't about whether you want an EV. This is about the whole philosophy of transition, and that is being challenged, as well as I don't know enough about the F-150, except they are big.
Matt Miller knows a lot about it.
Yes,
it's a short-term pain point for all these automakers, but
he's ordered a Cybertruck.
Really?
Yeah.
Tony Crescenzi and his Cybertruck.
Within 2 months, I'll have it.
Surveillance on the road in the Cybertruck with Tony.
Wow, can't wait. All right, you're going to have to send us some pictures on that. Coming up next, we're going to speak with Mandeep Singh about the new Apple device that is available.
Have you thought thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. New time starts Monday.
Google, Facebook, they all want programming for people to watch content. So content is more and more valuable. NBA content is hugely valuable, and so they're fighting over that. I think you'll see some consolidation. You'll see these streamers consolidating, back to the bundling, because it's inefficient to have multiple software systems, multiple marketing. So you'll see a rebundling, but the programming will always be valuable because it's the only thing that really aggregates eyeballs.
That was Steve Paliuga. He is, of course, a co-owner of the Boston Celtics, also CEO, chair, and founder of PAGS Group, talking about consolidation in the streaming space. It has yet to happen despite Paramount's best efforts to put itself on the sales block and look for buyers. No one has really emerged just yet. Maybe it's more of a price discovery effort. Nonetheless, we'll continue to watch for any kind of deal making in that space. But what we want to talk about right now is the Apple Vision Pro. And man, this is the headset thing that they debuted a few months ago, where it just looks like really expensive ski goggles. And when I say really expensive, we're talking about $3,500.
Yeah, I mean, this is about transporting you into alternative universes, seeing
good
content.
Marketing speak.
You see, that's me. In my fourth reincarnation, I will come back as a marketing guru at Apple. So this is just about transporting you into another world and another time. And it's about maybe how we experience all forms of media going forward. There's Apple. It's up double nickel. It's up a double nickel just before the bell. Today's the first day you're going to be able to order. How many of them will sell? 300,000, 400,000? Let's see.
Yeah, the pre-orders begin today, and of course, the actual device launches on February 2nd. Let's bring in Mandeep Singh, Senior Technology Analyst at Bloomberg Intelligence. And the headline here for the Apple Vision Pro is that YouTube, Spotify, Netflix, they've all declined to launch a new app for the operating system of this device. Why is that? Is this just they want to be convinced that this product is viable?
Yes, as well as, these companies have the engagement right now. If you look at where people consume Netflix, Spotify, and YouTube, it's on PCs and their smartphones. And they have those billions of hours of engagement. Why would they want to cannibalize that with a new device that potentially could work, but what are they going to get out of it? Apple is not paying for content here. So there is no incentive for Netflix, which, by the way, doesn't let you even sign up on a mobile smartphone, because Apple takes 30%, right. And we are going through that drama with Epic Systems case. So clearly the incentives for all these content players is very low in terms of making this device successful.
The lack of YouTube, Spotify, the lack of Netflix, plugins, can it materially hit the demand outlook? Because what are they penciling in for this product?
Well, so with any new Apple device, you know there will be diehard fans that will come and buy the product. So I wouldn't be surprised if it gets sold out, you know, in terms of pre-orders first week itself. That's going to happen. But the question is this a niche category or a broad variables market like an AirPods or an Apple Watch? And on that front, I do think, you know, headset computing in itself has been a niche category. Look at how much Meta has spent. They have spent $50 billion since 2013, last 10 years, and they have generated $5 billion revenue.
You're talking about Oculus, right?
Yeah, Oculus and what they have done with Reality Labs. They have poured in $50 billion.
Why does it not, I'm not going to say not work, because that's not
Why is it
true.
not taking off?
Why is it not taking off? Is it generational? Is it price point? What is it that's causing us not to want to sort of legally get away from it all?
Yeah, I mean, look, they've tried at the low end. Meta's lowest price device is around $400. So it's not about the price point. In fact, Meta is targeting mass adoption. But I just think it's a niche category.
$400 versus $3,500. I mean, there must be a difference in quality.
So Meta is going for quality here with all the bells and whistles. Right. They want to make sure you have a good experience when you put the headset on, all the processing power they need within the headset. I still believe headset computing as a category is a niche category. It's like gaming consoles. Why do you want to use headset computing in everything?
But if anyone can make it something big and make it something desirable, it would be Apple, right? Because
Absolutely.
It's been able to launch these new product categories in a way that others haven't.
Yeah, I mean, look at the watch. The Apple Ultra watch has, I think it's gotten a lot of traction for good reason, because they have combined a lot of things that people want to use when they think about fitness. But it's taken 9 generations of Apple Watches to get to that Ultra. So it will be a grind even with headset computing, and it will take multiple versions to get to that form factor. Still, I don't think it's a mass category. And that's the fundamental thing people are trying to figure out. Is it like PCs and mobile phones, or is it a niche category? And the answer is latter, I think.
Well, when it comes to Apple, does the Vision Pro represent a push again to keep refreshing its hardware line? Because we know that services is something that it's really been focused on. Higher margin and recurring revenue is always preferable to the blips that new product launches create. You look at the stock for Apple this year, it's down 2%, definitely trailing the other Magnificent 7 companies, and it's lost the market cap leadership title to Microsoft. What is it that Apple needs to do when it comes to the Vision Pro to change the narrative on its products and its buzziness?
I mean, look, from a device category perspective, it's great that they're adding another line. Whether it's a niche category or a big category, time will tell. I think they really are trailing when it comes to the AI front. That's where Microsoft has taken the lead, and for good reasons. It's probably 2 to 3 years ahead of everyone else right now in terms of their OpenAI partnership, what they have done in terms of Copilot launches, and that's where Apple needs to catch up, because they don't have a generative AI strategy till now.
It's interesting how the momentum for generative AI will be the fundamental differentiator, even within Mag 7. I want to talk about Apple Finance. Apple, we have these headlines, Apple's to open up to its rivals in Europe. This is on the ability to use your phone, to tap and pay. So it's really trying to get past the European Commission. They've offered a 10-year to other providers for the mobile wallet. How big will Apple Pay be as we go forward? We've got all the issues within Apple, but ultimately, it's about transactions and banking and money, isn't it? That's where the alpha can be.
Yeah, I mean, look, vertical integration always works when the experience is seamless. And what Apple Pay is doing, they've made that payment experience seamless. But they are getting a lot of resistance from the ecosystem as well as from the regulators. The whole, take rate that they have, 27% to 30%.
Chunky.
That's what everyone is sort of revolting right now. And there will be a fee compression. And that's where you are going to see. Yeah,
at some point,
it
will happen. All right, I'm looking at the Magnificent 7 and how it's done so far this year. As a group, up 1.8%. NVIDIA leading the way, up 15%, far away the best performer here. And chipmakers just got another lift this week when TSMC came out with its projection that it sees growth in 2024. How does this change the narrative on a sector that's, kind of trailed everything else within the tech world?
Well, so I think when it comes to hardware refreshes, everyone is waiting for that, you know, AI PC and AI-based refresh cycle. That hasn't transpired. Right now, everything has been data center driven, and that demand will persist, but I think the bar is so much higher that the room for positive surprises is going to be much lower this year than what we had last year.
Yeah, TSMC, of course, continuing to gain in trading and, of course, giving a lift to the European tech companies. There aren't that many, but there are some chip makers.
Well, there's ST Microelectronics, there's ASML. So there is the one thing that Europe doesn't have the bulk of the technology that you have here in the US. It doesn't have the Apple, the Microsoft, but it has the chips and the gear makers for the chips. Apple is up pre-market, what have we got, up 0.6%, but Advanced Micro Devices up another 1.6%. Chips all the way.
Chips all the way, and AMD is seen as the second best option, right, Mandeep, after NVIDIA, because whatever NVIDIA can't fulfill because it just doesn't have the capacity, it goes over to AMD.
Yeah, and they gave out a number of $400 billion number in terms of, you know, what these generative AI chips could create in a year, and that sort of demand. So even if they are a distant second, that's good enough to, you know, drive that kind of sentiment, but I still think the bar is much higher to drive those positive surprises, and that's what will, you know, probably restrict how much optimism we can have around the sector this year.
Yeah, AMD, by the way, man, is up 10% so far this year.
Yeah, okay. I thought I made a mistake there on the open. Yeah, Magnificent 7 levels. Let's see, does that continue to play out? Intel's up 1% before the bell as well. They've had a price rise from Raymond James to $54 from 48. But Apple's had 3 downgrades and only 1 upgrade so far this month.
Yeah, well, maybe things will change with the Vision Pro. If you're interested, go and pre-order it right now, available on sale.
Would you like one?
3,500, you're going to spring for me?
you. Mere bagatelle.
Mandeep, he's buying everyone the Vision Pros.
He's one of those diehard Apple fans, and
I'm just trapped in an ecosystem that I cannot escape.
And he's willing to spend to continue to stay in it. Mandeep Singh, Bloomberg Senior Technology Analyst. I don't want to give you a downgrade or anything. We're looking at futures right now, indicating a higher open in about an hour and a half. You also have pound weaker by 0.2%.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
You later got asked to be the head of USAID.
I got that job when I was 36 years old.
36 years old. You're running USAID. How many employees does it have?
We had 11,000.
And did you feel qualified to run something that big?
I did until, the work started.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I
don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg.
As the consumer demand stayed strong, you would start to see kind of a more normal cadence to things.
We think earnings are growing. The street thinks 11%. We think half.
Overall, tech has slowed, but it's still incredibly strong and one of the fastest driving sectors for growth.
What we see right now is a great deal of concern over what's coming. That's going to introduce volatility. I think that's going to continue in 2024.
We're in a great era where there will be some disruptors coming in and life may change.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, a very good morning. This is Bloomberg Surveillance. Alongside me this morning, it is Scarlet Food. Team Surveillance are, we think, wheels up from the
private airport, on private jets?
Airport.
Yeah, on the surveillance private jet?
Authority. Jonathan's there, the Learjet is waiting, Abramovich is on her way, and Anne-Marie Horton on their way down there. They've had a great week in Davos. Great team coverage from everybody. Francine has Linda, the whole team, a global coverage in Davos. But to this morning, what have we got? This is about whether equity markets can survive the momentum that they have on the way up in the face of a spike of 20 basis points at the short end of the curve. This is about readjusting your view on where U.S. rates go. We spiked by 20 basis points on the short end of the curve on 2s and on 10s. And yet, technology, the NASDAQ takes out a record high. So much for growth being busted on a blast from a spike in yields.
Well, we talked to different people about this, whether the bond market is seeing something totally different from the stock market. The stock market has earnings to distract itself with. Maybe that's the wrong way to frame it, but it has earnings to key off of. And earnings from TSMC, for instance, revived the chip sector and certainly gave all those big tech names a big boost. And we saw that yesterday in U.S. trading. We saw that in Asia trading, in European trading, and making its way back to U.S. trading once again, with NASDAQ futures leading the way.
Absolutely. And if we look at the flow show from Bank of America, they're telling us technology stock funds took in $4 billion. Now, this is whilst at the same time you saw a net outflow of U.S. equity stocks, but technology is still the destination. So much for the breadth trade, which was trade out of Mag 7, trade into a broader, perhaps Russell 2000, etc. But if you're going to extend, if you're going to have an extension on the rate cuts, in other words, they don't come until, let's say, the summer, maybe even the third quarter. As has been
close to the election. Ooh.
Dun, dun, dun. What does that do to the broader breadth component of value? Does it make it more challenging? I mean, that's an intellectual debate rather than an actual debate at the moment. Tech is flying high. In terms of a quick snapshot for risk, let's just run through it because we've got dollar resplendent up 1% this week. You've also got yields.
Resplendent. I like that. Yeah.
A magnificent moment for the magnificent dollar.
Up
the
about
presence of the Magnificent Seven. Who ever said that we couldn't do alliteration on this show in the absence of Jonathan, Lisa, and Anne-Marie and Tom? SPOOs are up, double nickel up 0.55%. Euro dollar is flat at the moment. The dollar has strided away as yields repriced up by 20 basis points. As I say to you, you give back a pip this morning. 412 is where they trade. So yields, are they going to level out there? You just had PIMCO. We've just had the conversation with him. He likes the idea of layering in here, buying in here. Don't be too greedy. Don't wait for the 5%. And oil is down 1/3 despite flashpoints in the Red Sea.
Well, that's because we're all pumping plenty of oil. and Russia, in Russia's case, exporting plenty of it. So the world is awash in oil. What did you say about double nickel and S&P futures?
Double nickel. So when you used to make a terrible mistake putting an order in to buy dollar yen, to buy oil or whatever else, double nickel. I want to buy 55 Nikkei futures. That's double nickel.
Okay.
Maybe it's an Irish thing.
I'm going to start incorporating into my daily speech.
Feel free. Resplendent, phlegmatic, and double nickel. You see, you learn things on this show when the others are away.
This is great. First time anchoring with Manis, and I'm learning so much.
It's been a good 2 hours. Let's not kill it for the third.
We would never.
Never, never, never. Let's get to David Lefkovich. He is the head of U.S. equities at UBS Global Wealth Management. Good to see you this morning, David. So we're waxing lyrical about the robustness of the equity market, record high for the NASDAQ, and yet yields are spiking 20 basis points. Can you join the dots for me there? Good morning.
Yeah, happy to do that. Thanks for having me. Yeah, I think as you guys were discussing earlier, I do think it's about earnings. If you look at the earnings picture, we're seeing what we think is a pretty nice reacceleration in earnings growth, which, at this point is really more concentrated in the Magnificent Seven and some of the technology parts of the market. But we think over the course of this year, that's going to broaden out and it's going to start to benefit more parts of the market. But specifically for tech, if you look at Mag 7, profits are up like 50% we expect them around 50% in the fourth quarter. So we're seeing some really impressive earnings growth. And I think you have to keep that in mind when considering what's happening with other macro variables like interest rates and things like that. So, I would say it's all about earnings at the moment.
When it comes to the earnings multiple, what kind of propulsion are we going to see? And I'm specifically interested in the likes of Mag 7 because I've had various guests earlier talking about 11% earnings growth, and they don't need 3, 4, 5 rate cuts to continue this equity momentum. That was my conversation with Deutsche Bank yesterday, 5,100 on the S&P 500 without any rate cuts. That's a heck of a call. So earnings growth and your call in absentia maybe of the 6 rate cuts.
Yeah, so I think the important thing is why is the Fed cutting rates? If the Fed is not cutting rates because the economy remains strong, I think the U.S. equity market will be pretty much fine with that. If the Fed is cutting rates because the economy is very weak, well, that's a whole other story. Mm-hmm. So I wouldn't get too bogged down on the precise level of interest rate cuts that are being priced into the futures market and sort of be expected by equity investors. I think it really just does come down to, will the earnings acceleration come through that the market is mostly expecting at this point, and we think it will. Look, obviously, if Fed rate cuts would help, but I don't. If it's a scenario where growth is still good, and that's why they're not cutting rates, then I don't think that's too much of a downside risk.
Okay, so the U.S. stock market can look past the delay of a rate cut so long as it's for good reasons, that the economy is holding up just fine and we don't really need it, and inflation is still coming down, but not to a point where the Fed actually needs to move. I want to bring in the corporate news that we got at the end of last hour, which is Ford cutting its F-150 EV Lightning production. And of course, Ford is not the only one. We've heard from Hertz selling down some of the Teslas and its fleet. These EV predictions that people had been banking on are not really coming to fruition right now. How does this change the consumer sector? How does this change the auto sector from where you sit?
Yeah, so we're neutral on the consumer discretionary. That's where the auto manufacturers live. And we do think, I think it's pretty clear that there's been some slowdown in EV adoption. There's been some of the low-hanging fruit has already been picked by some of the OEMs, and we're getting into the part of the market where, it may take a little bit more effort to sort of penetrate the market. So, but I don't think this is a broader read on the health of the consumer. We just heard from a lot of the banks. I would say the main message is that consumer spending is very steady in terms of growth. We're also hearing some from some of the retailers in terms of how holiday season went. So I think what's happening in EVs is very specific to EVs, and obviously that has implications for how you allocate to that specific sector, but I don't think this is a broader read on the health of the consumer.
Right. It also has a read-through for the supply chain, of course, for those EVs, all the suppliers there, not just in the U.S., but elsewhere. I want to bring in another headline that we broke for you earlier this morning, which is Spirit Air. It is surging right now after reaffirming its support for the merger with JetBlue, even though the DOJ blocked it. How are you thinking about consolidation in 2024 when clearly there's a lot of enthusiasm for deal-making given the expectations of lower interest rates, even as government regulators push back on any kind of combination? Or not any kind, but combinations that might reduce competition.
Yeah, sure. So I think, all capital markets activity, whether it be fundraising, whether it be M&A, it tends to be pretty pro-cyclical. In other words, when the economy is doing well, when the markets are doing well, that's when you tend to see a pickup in activity. Certainly if you listen to the investment banks, some of which have just reported, they talk about very robust deal pipelines and sort of a pickup in conversations. So look, I think if we really do stick this soft landing, and investors and corporate management teams start to have confidence that they don't have to constantly be worried about the recession that's coming, and I think you will see some additional deployment of capital and raising of capital. So I think it's just a natural progression. We went through a tough period in 22. Last year was a bit of a rebound, and I think now you're going to see that extend a bit.
Yeah, and it's not just in the U.S. either, where regulators are pushing back. The EU, for instance, Manis, the antitrust regulator there, blocking Amazon's proposed $1.4 billion acquisition of iRobot, the maker of Roombas.
Yeah. So regulation is going to come and at everybody in every direction. In terms of, David, we just get your sense on this. It's a theme that we've touched on in many different ways, but I'm looking at the UBS note, the CIO monthly letter. Lower interest rates will reduce returns and increase the reinvestment risks for cash and money market investors. Now, if we're going to push later and less rate cuts, is that phantom market funds, is that going to be slower to release? Is that going to materially impact, let's say, the momentum in these markets, or can we power ahead even without the flow of money out of money market funds?
Yeah, I think there's a number of different buyers for equities, whether it be what's coming from money market funds, whether it be corporate buybacks, obviously just broader institutional investors. So I think when it comes to the equity market specifically, I think the equity investors have a specific set of expectations. That there's an expectation that we'll see a resilient economy with resilient consumer spending and a pickup in earnings growth. And I think if that comes through, then markets can grind higher. Look, our price target on the S&P is 5,000 for the end of this year. It's not a lot higher than where we currently are. So a lot of this good news, the soft landing narrative, a lot of it is priced into markets at these levels, and there might be better entry points at some point in the coming weeks and months.
Right.
But I think at the end of the day, if the economy delivers, earnings deliver, markets can move a bit higher.
I know you like small caps. Is right now a good entry point for small caps? The Russell 2000 this week, at least, seems to be losing momentum to those big cap stocks.
Yeah, I think small caps look really interesting here. It is the cheapest soft landing play that of any sort of major sub-asset class or subsegment of the equity market, trading at a steep discount, not only to its own history in terms of valuation multiples, but a very steep discount to large caps. And it should benefit from a couple of different things. First, we're going to see a pickup in earnings growth this year. That should be a clear benefit. That should really clearly benefit small caps. Small cap earnings will probably outgrow large cap this year. Plus, a lot of the small cap debt is floating rate. So to the extent that we get rate cuts from the Fed, that's going to have an immediate positive impact on balance sheets, and it tends to be very correlated with ISM Manufacturing Index, and we think that it's likely that the ISM Manufacturing Index which has been below 50 for a long time, starts to improve this year. So I think there's a number of reasons to think that the risk reward looks pretty interesting here for small caps.
Okay, maybe that battle between growth to value it needs just a little bit more nuance in it, perhaps than we're putting in the icing on the cake this morning. David, thank you very much for giving us that additional nuance. David Libovich, UBS Wealth Management. Our guest this morning, a quick snapshot. We've got Spirit assessing the debt refinancing. They've taken several steps to shore up liquidity. The stock flies high, up 27% this morning, 28%.
Also, its preliminary revenue topped analyst estimates, but the actual earnings doesn't come out till later on.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The 2024 nominating contests are here, and the candidates are making their cases to New Hampshire voters ahead of the primary.
And we're off to New Hampshire.
Bloomberg is live in the ground, bringing you the fastest news.
Trump is leading by a long shot.
Insightful interviews.
And at the end of the day, that's what the American people want.
And the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
It all starts Monday in New Hampshire, only on Bloomberg.
I must say, 2024 is starting off from a banking perspective quite well.
We feel quite strong in 2024 as all of those investments are going to deliver for us later. But the direction of travel is the same. Clients are still there.
We're cautious because the economy is slowing down. The regulatory environment's really uncertain in the U.S. The rules around liquidity, the rules around capital, the Basel III endgame. 20% increase in our capital doesn't seem to make sense.
Regulators are looking in the wrong place, looking to over-regulate the banks.
It's going to be a bumpy year, but more than anything else, we've got to be resilient. We've got to be prepared to react to news.
The core investment banking activity that we have known with real cost of capital, traditional corporate finance like the mid-90s, I think it's going to come back.
I'm very much concerned about the small and mid-sized banks. They've got several risks happening at this point in time.
There's always concerns, but today the regional banks are stronger.
The banking leaders of the world sounded optimistic in Davos this week, as are markets. As yields rise, equities have risen in tandem. Can that endure is the question I have in my mind. You're looking at the S&P 500 up 0.6%. The leaders in the pack this morning are all in the tech. AMD, Nvidia, both flying higher this morning. So it is about the chips. It's about day two of that solid growth story from TSMC. Apple's flying higher as well. Euro dollar is flat at the moment, and yields give back just a pip or two. We have ramped higher at the 10-year paper by 20 basis points this week. Scarlett.
Let's talk about what's going on in banks, because bank earnings season is pretty much over at this point. The big banks finished reporting, and the regional banks, the bulk of them, have finished reporting as well. They started and they finished. Herman Chan, senior U.S. regional bank analyst for Bloomberg Intelligence, is here with us now. And we take stock of regional banks in a way that we hadn't before because of what happened in March of 2023. Right. What are we learning from the regional banks about how they've fortified their balance sheets following that?
Sure. So after the March and April episode and the banking turmoil, after the failures of a few regional banks, the remaining players have really fortified their capital base, pulled back on lending a bit to be a bit more cautious given the operating environment, and really try to stabilize their deposits. And they've done that by increasing the rate paid on those deposits. So at this point, things have stabilized, and we're past that turmoil back in March and April.
But it's costing them to pay for those deposits.
Correct.
And a lot of those deposits have fled, gone to bigger banks, or gone to higher yielding instruments. What portion of those deposits have come back, or are they still waiting for that?
Yeah, so I would say that some are still coming back, but we have largely stabilized. So we're at a steady state now. Bank balance sheets aren't really growing because there's not a lot of loan demand either. So we're looking at 2024 as a bit of a slog year where there's not a lot of balance sheet growth, and we're expecting potential rate cuts, which could help deliver some loan growth in the back half of the year.
Listening to Ms. Walsh at Guggenheim, she was very clear. She is worried about regional banks. I mean, last year, nobody saw the truck coming down the highway at all. It's a thing called mark-to-market. It's been around for quite a long time.
But you can ignore it for a while until you have to deal with it.
You don't want to worry about that. She is worried, and she's worried on two fronts. They've got several risks happening. Commercial real estate exposure, depends who you talk to on that front, and a refinancing wall in that space. So are they real risks or perceived risks? Because when a lady like this speaks to me, I tend to listen.
They are risk, and the banks are preparing for those risks now. They're adding more to their reserves for the eventuality of loan losses in areas like office commercial real estate, multifamily apartment lending. So those are risks that are known. They still have to play out over a number of years. So it's more of a slow-moving train wreck at this point where the loans mature this year, next year, and the year after. So you'll see losses, but at this point, it seems like it would be fairly manageable.
So Jamie Dimon and JP Morgan, we shouldn't just put it as the individual, but the institution in of itself, saved the banking system again last year by taking hold of those who were flailing. Will there be a greater consolidation in regional? This is a perennial question.
Yes.
Everybody asks it and they go, oh, here we go. Is there going to be any more consolidation?
Janet Yellen was wondering about that too.
Well, if she's a lot more smart than I am, Ms. Yellen, is there a real case then for significant progressive consolidation? I don't mean crisis consolidation, but real consolidation.
Well, that's the question that a lot of regional bank CEOs are asking themselves now. What's the aftermath of what happened in the banking turmoil last year? Do they need to be bigger? Because if you look at where the deposits fled in March and April, they went to the biggest banks. And the regionals see this as a potential existential issue if another recurrence happens again. So bigger is better. A number of CEOs have talked about the need for scale to compete in these potential existential crises. And banks are looking at potential M&A opportunities. It might not happen in the near term, but over the long run, we're going to see consolidation.
Well, that mark-to-market comes back again because everyone wants lower rates, because if in a takeout, you've got to mark everything to market. So let's wait for rates to come down, and then we can get things going on the consolidation
absolutely
front,
correct.
Right? Okay, I've got to ask you about, given we're talking about crisis, the OCC chief, Michael Hsu, told Bloomberg that regulators may force banks to start tapping the Fed's discount window at least once a year. He sees it as kind of a fire drill so that banks are better prepared to respond to any kind of sudden flight of deposits. What would the government need to do to make borrowing from the discount window more attractive, aside from ordering everyone to just do it?
Right. I think that's really the case. He mentioned it being more of a fire drill every year, so it makes perfectly sense to be able to be prepared for a potential crisis. And I think the measures that he's taking make sense to me. At this point, the banks are a bit wary just because of optics issues and signaling issues. issues. But if we get everybody on board, and it seems like regulators are a bit resistant for banks to tap the FHLB, the Federal Home Loan Borrowings program as well. So maybe it's a way to ease out of that into the discount window over time.
Is there a contrast to be made between the discount window and the Fed's Bank Term Funding Program, where banks do continue to borrow record amounts because it's proven to be a reliable and profitable arbitrage trade where you borrow cash and then you park the proceeds at your account with the Fed where they earn a higher level of interest?
Right. So the BTFP seems to be getting some uptake over the past few weeks because of that arbitrage opportunity that is unfortunately going away in March. So it'll be a bit short-lived.
It's like a last hurrah.
Exactly.
We all like a last hurrah. Thinking of which, the mortgage market. Mortgage rates are coming down incrementally from those zeniths. For the regional banks, look, when these rate cuts come, everybody's telling us there's either going to be 3 or 6. They're bid and an offer. Okay, one is the Fed, one is the market. But that is going to have a material impact on mortgage lending. How exposed and how much of a floor will that put that real estate lending in the commercial banks? What will it mean for them if rates come down on the residential mortgage market?
Yeah, so residential mortgage lending has been pretty tepid over the past few quarters. When we get rate cuts eventually, you'll see more activity, and that'll help both on the fee income side and the loan growth side. So it would be very much welcome on the residential side of things.
I'm just hoping that my FICO score goes up and that somebody out there wants to give me a mortgage.
You're waiting for mortgage rates to come down.
And I'll get I'll get a first buyer's mortgage as well. A bit of a.
Do you spend your weekends looking at property?
Not anymore. My brother has told me I've got to calm down, slow down, and reevaluate my life, which I will do. We'll know more about the property market and rates market by the end of this year. Herman Chan, Bloomberg Intelligence, setting the table. You don't really want to know about my FICO score and my availability to mortgage.
You've got time to build it up.
Yeah, I'm hoping. With one of the big banks.
Open lots of credit cards.
No.
But that helps your credit score initially, as long as you pay for it.
That's where I floundered in the late 90s. We're not doing that again. Okay,
yeah,
we're not
learning the hard way.
We're not going through that again. Let's have a look at the last hurrah. How's my pension fund doing? The S&P 500 rallies a little bit this morning, up 0.5%. There we go. Am I fully invested? That's the question I asked the broker who I know is watching this show at the moment.
Is that double nickels?
That is not double nickel. Double nickel is 55.
Oh, so you can't round it up to 56?
No, you cannot round it up.
That's too bad. Okay.
One and done. 414, we give back a pip on not even a pip.
Barely.
We can't really say anything more about bonds, can we?
It's unchanged right now. Not for the week, but for today.
Okay, surprise of the week has really been the sort of flat response. We'll not use the word phlegmatic again. Flat response on the oil market to heightening tensions in the Red Sea. Next up, Greg Dacko at EY.
used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world starting Monday, every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance. Alongside me this morning, it is Scarlett Fu. I'm Menace Cranny. Your regular surveillance team we have it on good authority, standing by to get on their chosen mode of transport back to the United States.
Private jet.
Private jet, Lear. There we go. Well, nothing else would do. S&P 500 up a half of 1%. The stock market is continuing to take its lead from the TSMC. The chips narrative from yesterday, solid growth. NASDAQ made a record yesterday. And again, the possibility of a rate cut in March goes down to just more than a coin cost, 50-50. We've had $165 billion of a chip rally so far this year. And it is about earnings growth rather than rate cuts that propels this market. Roll it over and have a look at the rest of the market. You'll see bond markets ticking.
They're not concerned with earnings, by the way, the bond market.
They are completely divorced from what's going on. I mean, Waller and Bostic re-stoked that fire and re-grasped the narrative to cause the bond market to recalibrate its view on when it would get a cut, how much it would get a cut. And the problem is that you have a group of bond market participants who have recency bias, which is GFC, which is pandemic, which is taper tantrum. This is not where we are in 2024. Message from MVC to the market.
Yeah, well, it'll take a while to get that message through. Everyone's still looking for somewhere in the neighborhood of 5 to 6 rate cuts, according to market pricing.
Indeed. Now, we've had some breaking news, as you and I were on air, in Ford. Ford has announced that they're cutting the production of their F-50 Lightning EV. Now, they say the move will, quote, achieve the optimal balance of production, sales, growth, and profitability. The company instead increasing the production of the Bronco and the Ranger models. Both run on, guess what? Internal combustion engines.
And cheaper as a result.
Look, the bottom line is, what does this say about demand for EV? Is the infrastructure not there, or is it that we don't and we're not prepared to buy EV because we've got range anxiety, or is it because we're a bit more drawn to other propositions? The gas guzzler still lives to fight a long day.
It's a combination of all three, I think, but range anxiety certainly exists. Perhaps the people who wanted to get EVs have gotten their EVs, and for the rest of the population, if you don't have a garage and you can't charge it at home, then what are you going to do? You have to line up, and by the way, when you charge an EV, it takes like 15-20 minutes to do so, whereas when you go to the gas station, 5 minutes and you're out of there. Time is money, right? So people don't necessarily want to sit around and wait for that. And also, maybe the projections for EV sales just got ahead of themselves. There's still going to be growth, according to Ford, in global EV sales this year, just not as robust as many people had anticipated.
Now, of course, there is an impact on this. You're going to have a few dozen workers will be impacted at the components plants. So this is about adjusting the cadence of what they're doing. In terms of other news flow, Jamie Dimon. He's getting a pay rise. Well done, sir. The bank posts the highest profit on record of American banking. Remember that. According to the filings, Mr. Diamond was paid $36 million in 2023, up from $1.5 million increase from the prior year. And the bank making almost $50 billion last year, with the shares rising 25%. So that, look, you can understand the validation. By the way, that is the highest profit in American banking history. So you can sort of understand this is an incentive-led business. If you deliver the return on equity, you deliver the return for the shareholders.
And he's delivered for JP Morgan for a long time. He's been at the helm of JP Morgan for 18 years. Every earnings season, we look ahead to what kind of compensation numbers these CEOs get. And Jamie Dimon scoring a 4.3% annual increase. And of course, a chunk of that is going to be in bonuses. What is it called?
Well, 34.5 million of it is in performance-based incentive pay. By the way, there was a little bit of something for everybody at JP Morgan. I hope it trickles down to the normal levels. Daniel Pinto getting $30 million. You've got other pay rises for Mary Eddowes, $27 million. So there is munificence aplenty. But then, of course, that's the pay. We know the pay and wages are something that the Fed are focused on. But with Congress, they have avoided a partial shutdown. They're passing a short-term spending bill, pushing new deadlines to early March. President Biden is expected to sign that legislation, Scarlett, today, despite nearly half the House Republicans opposing it.
Yeah, I'm fascinated by this because the only way this got through the House with Mike Johnson as the Speaker of the House was with overwhelming support from the Democrats. The House Freedom Caucus was not happy about this. They wanted certain things. They wanted changes to the border policy, which they did not get here. And the big question is, how long does Mike Johnson have in his speaker role? How long will he be able to hold on to his gavel before there's some kind of rebellion from his own conference? And it's not clear. Will it be, past March 1st and March 8th when the new deadline is, where they have to now come up with a new agreement? I don't know.
No, but, that speaker seat is tenuous at best. Greg Dacko is the chief economist at EY. Good morning.
Good morning.
Tell us this now. We've had this quite bullish narrative from Davos. We were just chatting about this in the break. How do you look? I mean, the American economy is strong. The consumer, by all accounts, is robust, even though they're dipping into the last of their savings and spending like Billy on their credit cards. I don't call that strong. What do you make of it?
Well, I think it's a nuanced outlook when you look at the U.S. economy. We still have positive momentum, and I think one of the key pillars to economic activity remains the labor market. We have a labor market that's still delivering a decent number of jobs. We still are seeing job growth around 150,000 on a 3-month average, and we have an unemployment rate that's still well below 4%. So that's what's driving income, and in turn, that income is supporting spending. I think we have to be a little bit careful with the cracks in the foundation of consumer finances. Yes, people are using more credit, but if you look at credit relative to spending, it's not historically that high. It's actually below where it was before the pandemic. So yes, there is a little bit more use of credit, and we have to monitor that carefully because debt servicing costs are on the rise, but it's not excessively worrisome. There are some pockets, credit cards, auto loans, but broadly speaking, consumer loans and mortgage rates, which are locked in at low rates, are not excessively worrisome.
Okay, so nothing like what, the groundwork for the great financial crisis back in 2007, 2008. In terms of data that Manus was talking about that came in better than expected, jobless claims, retail sales, how does that set us up for the fourth quarter GDP print that we're going to get next week? Because that is going to show a measurable slowdown.
Yeah, I think we are going to see a slowdown from the 5% pace that we saw in the third quarter. But we know that the 5% pace was supported by a lot of strong summer spending activity.
Taylor Swift.
Beyonce, and other movies.
I did not. Couldn't get a ticket.
Fans, I wasn't either. But we are seeing that consumers are exercising a little bit more scrutiny when it comes to their purchases. Retail sales were very strong at the end of the year. We saw strong momentum in terms of December sales. We saw a lot of activity. If you walked around in in malls. You saw a lot of people buying online, but also buying in stores. What is important to note is that there is a bit of a delta between how much people are spending on a nominal basis and how many goods and services they're purchasing on a real basis, which is a little bit flatter.
You know, Manus started us off by talking about how the Magnificent Seven is back again. Everyone is all in on AI right now. Yeah. Certainly you see it in the share prices like NVIDIA and AMD. When does that start to show up in the data that you track, whether it's GDP, whether it's any other measure?
I think that's a great question because we are at an inflection point when it comes to the economy in terms of this cost and supply issue. We are in a globally supply-fragile world where supply constraints remain very much a risk. Productivity growth via process improvements, but also technology, is one avenue through which you can lift, of course, productivity growth and output, but also ease inflationary pressures. Now, it's not going to happen overnight. It's going to take a lot of time for companies to develop the technology, to integrate it into their daily processes, but that will lift economic output. We're doing a series on AI, and we're seeing some potentially very strong boosts, talking $1 to $2 trillion for the U.S. economy over the next decade from Gen AI.
Do you think we're underestimating the speed of adoption of AI? I mean, we underestimated. I remember, do you remember when you had a mobile phone and you said you'll never watch a movie on a mobile phone? Well, I did.
And all of a sudden, 2 hours later.
You'll never watch a movie on a mobile phone. Suddenly we're communicating, we're using Zoom. You've got every app to communicate in crisis on the phone. I just wonder, I look back at Alan Greenspan, you remember the speech that he made about the internet, the bubble, the new paradigm in terms of economics, etc., and he was bang on the money. Has AI an even bigger propensity to be an even more significant contribution to growth than we currently understand relative to the birth of the internet?
Yeah, I think in general, if you look at technological innovations over the past 100, 200 years, the speed of adoption has increased. You're looking at 50 years back in the 1800s to 10 years during the technology age of the internet and computer age to now maybe 3 years. That might be the next environment in which we see those positive benefits. I think the other important thing to note is that you may remember that back in the 1990s, Bob Solow famously quoted that essentially productivity gains from the computer were everywhere except in the stats. And that's perhaps what we might see in today's environment with a lot of positive gains in terms of company activity, but not necessarily visible in terms of the actual economic statistics.
Yeah. You talk about adoption. How are you using AI right now in your day-to-day work? Because you do say that it's helping you do some of the mundane stuff and putting you in a position to, jump in at a later point than where you would have started.
Yeah, I mean, what Gen AI allows you to do is essentially have an assistant that allows you to speed up some of the processes.
Right.
Whether it's writing or data analysis, you can use Gen AI in a way that facilitates your work. Now, you still need to think about, the analysis that you're writing in terms of an economist and how things will evolve in terms of forecasting, but Gen AI really has this ability to simplify and speed up some of the early phases of the processes, and things that perhaps took a lot of time before can be done much faster with Gen AI.
Manus, do you use ChatGPT or any of the AI stuff?
I really genuinely resist it because...
You're old school.
Not so much that I'm old school, but as in I do believe that when you're trying to prepare and create for a conversation with somebody, I just believe you just try and do the research and formulate some kind of thought processes yourself. But maybe I'm wrong. Maybe I'm foolish. Maybe I should just sort of tap it in. Questions for EY Economy USA. Wouldn't that be, well, I don't know, correct me?
Well, it's quite dry if you do it that way, but if you integrate Gen AI into the daily processes, which is what EY is doing right now, investing a lot in Gen AI and trying to facilitate processes of data control, data analysis, data forecasting, as well as processes in terms of management and leadership. So it's really all about knowing how to use it, and that is one element that we tend to underestimate. Oftentimes, when new technologies come on board, you think about the basic uses first, ChatGPT as a chatbot, but then you have to think about the possibilities that go beyond that and how Gen AI can help functions across the board, not just in specific, what am I going to eat today? How can I create a recipe for tonight?
4 questions for you the next time you come in. Do you use it?
No, I haven't done it yet, although I know others who've used it, and maybe they'll use it to just kind of create a template for how they're going to fill out everything else later on.
Okay, I mean, look, it's
giving you a starting point.
Look, I'm a complete believer in, I mean, I've moved away from paper. I used to have paper for every single guest just because I've been caught so short with technology so many times, stuck on a side street or in the middle of a desert. But can we just flip it around? I mean, these are all the progressive, constructive, productive, value-add, economic ads. There is going to be a flip side to AI, which is going to be the less need for humans. And if so, what is the quantum on that? Have we begun to think about how it will impact employment, quid pro quo, unemployment?
Yeah, well, I think it's not just replacement, it's augmentation that we have to think of. When we look at the economic impact of Gen AI, we're looking at the capital investment necessary, the infrastructure, cybersecurity, adoption by companies, development of software. Then you look at productivity gains. If you combine all of those can have a significantly positive effect on GDP growth. We're talking in our baseline 3.5% additional GDP over the course of the next decade in a baseline case. In an optimistic case, about 7%. That's $2 trillion of additional economic output. Globally, you're talking about $2 to $3.5 trillion of additional output. That is going to also create new job opportunities, different job opportunities. Yep. And when it comes to the great job reshuffling, it's not the case that it'll replace all jobs, it'll augment them.
Certainly different ones than we currently think in our mind's eye. And this is about trying to cast forward with your imagination. We need one of those, not the Oculus glasses, we need a new pair of the Apple.
The Vision Pro?
$3,500, send them in, we'll have one. Greg, thank you so much for being with us.
Dennis is buying for everyone, by the way.
I'm there. Where's your Amex?
I have that.
Okay, we're going to leave you with a thought on markets, slipping back slightly, but we're still up at 48.33. Stocks are rising. Good morning.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but this is, my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Interesting to me about the diversity of opinion about rates and stuff. Where we stand on this is that we think earnings are growing. The street thinks 11%. We think half. The street thinks that rates are going to be cut 6 times starting in March. I'm not there. Okay, I can tell you why on that. We think 2 to 3 times.
Ronald Khrushchevsky, the Stifel Financial Chairman and CEO. Heresy not believing that the Fed will cut 6 times. It is a building consensus. Mohammed El-Arian's column this morning, the voice that you've just heard there, and a cacophony of voices from Davos. Readjust your monitors. Quick snapshot of the equity markets. They still believe that earnings are going to blow high and hard. S&P 500 up 0.5%, euro dollar flat, 10-year yields blew up by 20 basis points this week on the back of Waller's comments about methodic and cautious rate cuts, and Bostic reaffirming that it could actually be as late as the third quarter. And that's really what it is about, recalibrating your view on this rate cycle, isn't it, Scarlett?
It is, but we do get more Fed speak today, so maybe that will blow those guys out of the water. Goolsby, Daly, Barr, and Daly once again. Daly doing a Daly double for us.
It's the closing act by Mary Daly, by the way, because she will be the last Fed speaker before we go into the quiet period, I think. So let's wait and see what happens there. We've had earnings aplenty. Gina Martin-Adams is the chief equity strategist for Bloomberg Intelligence. She joins Scarlett and myself now. So we have one consistent theme. I've got no sort of like trashy tagline, but I've got one consistent theme from the past 3 hours. Earnings are strong. They will remain robust. They'll be double digit, and that's what will carry us to the higher ground. Gina Martin-Adams, good morning. How strong will the earnings be?
Yeah, I think it just depends on which sector you're looking at. Financials clearly started off the earnings season in the U.S. relatively weak, mostly due to charges related to the FDIC sort of special situation reflecting what happened with Signature Bank and SVB last year. But when we move into tech earnings, which really starts next week, the anticipation is for much stronger, robust earnings growth to emerge. That then rolls into more industrials and materials earnings, which should be relatively weak, followed by consumer earnings. So I think you're going to have this rolling earnings season where we started off weak, we might get strong, we weaken again. It really is a sector by sector story. When you look at the S&P 500, this is kind of a blah earnings season. For lack of a better term, we're looking at about 1% earnings growth. So nothing to write home about for the large index, but certainly a lot of sector and industry stories to follow with the fourth quarter season.
And if you hop on your Bloomberg terminal and pull up your bio, recovery could broaden beyond the Magnificent Seven. My dexterity with typing names into the Bloomberg blows my mind. Here we are. Now, you set the stage, which is you take me back to the beginning of last year. I was in Dubai. It was the halcyon days. It was balmy. It was warm. It wasn't like it is now, freezing and in boots. But here's the thing. Mag 7 growth on the earnings was 31%. The rest of the world was febrile. Yeah. Talk me through how that will play out in your mind, Mag 7 versus the rest of the market right now. And is that what's infusing a bid for Mag 7?
Well, this is, I think, very clearly the earnings landscape was one of the biggest reasons for the Mag 7 to outperform the S&P 500 in 2023. As you correctly note, the rest of the index, when you exclude the Magnificent Seven, had an earnings decline of 6% last year, so clearly was in a recession, whereas the Magnificent Seven posted greater than 30% growth. As we move through the course of 2024, this should be very, very interesting because the consensus is anticipating that by the time we get into the second half of this year, we'll have 13 to 14% growth for the Magnificent Seven. We will also have somewhere between 13 and 14% earnings growth for the rest of the S&P 500. So I think this is one of the big keys to 2024. Will we see that modest rotation with the Magnificent Seven earnings growth rate slowing down a little bit, still maintaining a double-digit pace, but much of the rest of the S&P 500 starting to catch up. You had notable sectors that producing very strong earnings declines last year, like healthcare as well as energy, that should start to contribute to earnings growth this year. And this is a big story for the index at large.
Right. Well, I mean, you have easier comps in the second half, too, given the declines that you were talking about. We know that the Magnificent Seven, notably Meta, for instance, made a lot of cost cuts, the year of efficiency, all of that. How much is the Mag 7 and tech overall getting a boost from cost cuts in their bottom line versus revenue growth?
I think it's a good bit of it. When you look at the revenue lines, though, the Magnificent Seven is growing at triple the pace of the rest of the S&P 500, so it's not just about cost cutting. It certainly was very early in 2023. This is what sparked the recovery, was cost cutting by Facebook or Meta as well as Google. Across the board, the tech companies generally were the biggest had the biggest layoffs among sectors and industries in early 2023. We've seen the cost cutting, however, give way to revenue growth, and I think think this is an important sort of consideration. When you look at something like TSMC's announcement this week, this is about revenue growth now and not just about cost cutting, where revenues are growing at a very significant fast pace relative to the rest of the index. And that's what's really powering the gains for the space.
So you mentioned TSMC, and obviously TSMC makes chips for the likes of NVIDIA, Apple, so it's really B2B. The customers are enterprise customers, and that gives us an important read into corporate spending. Technology exposed is, of course, exposed to both corporate spending and consumer spending, and here I'm thinking about companies like Apple or Netflix. Do we presume that corporate spending is going to hold up better than consumer spending?
I think we're at that stage of the cycle, Scarlett. What we saw last year and the year before, frankly, were pretty significant spending cuts by corporates to catch up with what was happening in the earnings stream. Remember, all the way back in 2022, we started an earnings recession for corporates. So corporates have adjusted. They went through an earnings recession. They're now starting to see cash flow growth again, and that is going to be reflected in capital spending as well as investment trends where you see those pick up. On the contrary, the consumer may not weaken materially, but there's very little to suggest the consumer may accelerate spending in the near term. Everyone, of course, has been on guard for this consumer recession to emerge. Will we start to see the unemployment rate hook higher? As a result, that may deplete income prospects for the consumer space, which may result in relatively flat to slower spending in the consumer leg of tech.
I'm drawn to the narrative around healthcare. Lots of people since the start of the year have been saying, get involved in healthcare, but you need to disaggregate healthcare, don't you? You've got healthcare, which has got high-end AI technology imbued in it, because you talk about the margins in general healthcare, and the general healthcare margins you would say are the lowest in nearly a decade, a margin of just around 7%. But they're not all created equal, are they? So how do I begin to take healthcare apart?
Yeah, I think you want to look at large versus small to start with. Within the large cap S&P 500, healthcare is really not about technology almost at all. It really is about large cap pharmaceutical companies dominating the market cap of healthcare. You do have some life sciences companies. Biotech is a relatively large share, but it really is about pharma. What's happening with pharma tends to drive healthcare performance unless you get a rip-roaring gain in the rest of the segments. Within small caps, it's a little bit different. Small caps tend to be higher beta. They tend to have more leverage. So I think it's a very different story whether you're looking at large versus small. In the S&P 500, it's about pharmaceuticals. And will these pharmaceuticals companies get past the charges that they've had to make, start to see more activity emerge over the course of the year ahead? I mean, you've got hospitals and providers in there as well. I don't think that's a tech play either. So you really do need to pick your spots relatively carefully. And what we're seeing in healthcare, really, especially in the large cap index, is very difficult earnings conditions. This was one of the worst earners throughout 2023. The anticipation is those easy comps may produce some earnings growth in the year ahead, but it is just about easy comps. There doesn't appear to be a lot of optimism in a longer-term revenue recovery emerging just yet.
Okay, we'll keep an eye on those sectors. Gina Martin, Adams, Bloomberg Intelligence, setting the stage on the earnings season so far. Next week's going to be, was next week the busiest week of it all? It's going to be
so far it's going to be the busiest, but I think it's going to be the second busiest overall. Netflix begins reporting, so it kicks things off for big tech, as Gina was mentioning.
Okay, make sure you don't share your password. We want to talk about Wayfair. Wayfair is spiking higher.
Yeah.
They're in 19. I mean, this is a very strange phrase. This is called workforce realignment. But we're looking at what, 13% of the workforce?
They're cutting jobs. 13% of their staff globally, 1,650 workers, and 19% of its corporate team as well. So the first quarter cost will be anywhere from $70 to $80 million.
Look, I'm only beginning to understand some of the brand names here in this country and where you go to shop. So unfortunately, Wayfair isn't on my sideline.
If you were here during the pandemic, you would know Wayfair because everyone ordered furniture off of Wayfair.
But here's the canary. I'm not saying this one stock is the canary in the U.S. corporate coal mine, but when you begin to see fundamental changes in companies like that, beds, living rooms, etc., that's where the tough parts are. And this is about the truth for the consumer.
Right, and consumer spending might start slowing in 2024.
Indeed. Coming up next, The Open with Lisa Shallett of Morgan Stanley, Zachary Griffiths, Credit Sites, along with a whole host of guests on Bloomberg.
Access the financial world on demand. Here's Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From New York City to our viewers worldwide, I'm Alex Steele in for Jonathan Farrow. Take a look at where we are. NASDAQ 100 continuing its record climb, pushing the S&P near a record. And small caps, no slouch either, up by 0.3%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, chip makers powering the latest tech-led rally. Congress averting another shutdown showdown for now. And the Fed set to go dark as the rate cut debate continues. And we begin with the big issue, the tech turnaround.
The poster child for high quality is the U.S. tech sector.
The big tech stocks.
The tech sector has done very well last year.
What drove the market last year was that magnificent 7.
We had the big AI boom pushing through earnings for tech stocks.
The AI and the AI hype.
Maybe we're seeing a little bit of that enthusiasm at the start of this year.
It's a positive background story for growth, for equities, and I think it's probably going to stay for a while.
Tech earnings are supposed to be up in double digits.
Valuations already very high.
Expectations could be on the higher end.
We still like tech.
Big tech is absolutely fine.
You don't want to run away from big tech.
We still think this is a sector you want to be overweight.
The enthusiasm is there, the flows are there, and also the valuations.
It's not as if that the long-term themes around big tech have gone away. They haven't.
So far, tech stocks have been able to deliver.
Well, joining us now to discuss is Zachary Griffiths of CreditSight. Also, Morgan Stanley's Lisa Shallett will be joining us shortly. Okay, what I definitely don't get is why tech is rallying?
It's a good question, Alex. It's been an interesting start to the year. And when we think about what tech looks like from a credit perspective, looking at the bonds, it trades extremely tight. And so we're actually underperform on tech from a corporate credit perspective, at least in the investment grade space, as we think a lot of the good news is kind of priced into the market. And when you think about, at least again, from a fixed income perspective, credit spreads so tight, the opportunity to outperform in that type of environment is very limited.
Right, and we've been hearing a lot on the equity side about how positioning is really stretched as well. Now, you could look at it one way that, okay, TSMC yesterday, maybe the trough is in for the semis, and that's going to wind up helping overall tech. You could also look at it as maybe this is a safety play. No one knows what the Fed is going to do, therefore you need the safety. What do you think?
Yeah, I think the Fed argument is certainly there, and there's been a lot of uncertainty or at least repricing over the past couple of weeks in terms of the dovish pivot we got from the Fed in December, and now a little bit of a rethinking of can the Fed actually ease as aggressively as the market has priced. And while we think the Fed is closer to easing than it has been at any point in recent times, we also expect that there's only 100 basis points of rate cuts in 2024. So the market seems a little bit overdone from that perspective. And I think you could see a little bit more caution. So that safety argument certainly makes sense to us, Alex.
Yes, and everyone seems to agree with that. Mohammed Al-Arian, a Bloomberg Opinion, weighing in on that point, saying, I wouldn't be surprised if we start later, probably the beginning of the summer, and I wouldn't be surprised if we end up the year with cuts that are closer to what the Fed has signaled, which is 75 basis points, as opposed to what the market has priced in. Bloomberg's Michael McKee joins us now. Mike, what are people talking about as we head into the blackout period?
Well, it's interesting because we've had a lot of Fed officials pushing back against the idea of earlier and more cuts, and the market is only just beginning to think about believing them. Here's where we are right now. I mean, over the course of this year so far, we've seen unemployment stay about unchanged, under 4%, while the PCE inflation numbers have come down regularly. And look at consumer spending going back up again. Now, Michael Gapin at Bank of America has a note out this morning saying, ignore that. It is just seasonal adjustment. The economy is cooling, and next week we'll get an idea of how much the economy has cooled. But as I said, the markets are taking this as an indication that either the economy is cooling and you need to cut rates, or the economy is just fine, inflation's cooling, and you can cut rates. And you look at what the Fed is forecasting, which is 3 rate cuts this year, and the market's still at 6. It's come in from 7, but still at 6. That's the white line there, and something's got to give between those two things. What we're looking at is a very, very slow change as Fed officials come out and talk about it. It'll be interesting to see in 10 days now whether Jay Powell pushes back as hard as others have, because at the moment what we're seeing is that there is no move expected for the January meeting in January 31st, but the December meeting still, as I said, the yellow line there pricing in a 68% chance of 6 rate cuts, while the March meeting, the white line, now down to just 51% chance of a move. So a slow move by the markets towards the Fed, but not yet where the Fed is.
It's still 51%. It's nuts. Hey, Mike, thanks a lot. Really appreciate it. All right, so Zach Griffith's still with us. Lisa Shallett joins us now. So, Lisa, the tension then in the market, which is going to explain all the other asset class moves, is does the market meet the Fed, or does the Fed have to meet the market? How does that resolve itself?
Well, look, I don't think that we're in a period where there's any pressure whatsoever for the Fed to meet the market. You know, that usually happens during periods of distress. Right now, we have an economic backdrop where, you know, some of the growth figures, including retail sales, are surprising on the upside. The Fed has ample room right now to take its time to digest the data. Overall, capital markets are reasonably stable. I mean, equity investors may not be, super excited that the rally that we saw in November and December has stalled out a bit. But there is no crisis here. There is no one yelling fire in the theater. And I don't think the Fed has any need to do anything other than what they're doing, which is, the Fed governors are out speaking, very data-driven, very rational, and pushing back very softly on markets that just got ahead of them and unnecessarily ahead of them.
Which just begs the question, kind of, the why behind the cut, Zach. Like, is it going to be because inflation's coming down, growth tanks, or just a normalization? Like, let's, cut a little bit here, wait and see, bring that real yield down a little bit, but not an actual sort of easing cycle, Zach.
That's exactly what we're looking for. And when we think about our call for rate cuts in 2024, it's really directly linked to our inflation call. We think that core PCE could move about 100 basis points lower, back toward around 2.25% by the end of this year. And so thinking about wanting to maintain the real policy rate more or less steady, maybe pull it back just a little bit, there's your 100 basis points of rate cuts. And if you look at the Fed's forecasts for core PCE, and in the dot plot, they have 75 basis points of rate cuts and the pace of core PCE coming down just about that much. So we seem to be on the same page there. It's interesting to see the market move so much, and it almost seems as if the market had been pricing more of a recession type scenario, which isn't our base case.
Right, which then maybe that's why you want to go buy growth in tech, because now we're pricing that out. Still confusing to me. Lisa, so is it going to be a real cutting cycle or a normalization? And how does that change how you allocate?
Well, here's where I think definitions matter a lot. The market seems to think, on the positive side, I get a soft landing and all the improvement in profits that go with that scenario, a more accommodative central bank, but I don't, get any of the potential negatives, which is a softening potential increase in unemployment. I think, on the flip side of things, we have to, ask ourselves, could things actually be a lot worse, to your point, if the Fed's cutting aggressively, is because there's a recession, and that's not what you're pricing. So it has been somewhat incongruous in this scenario where investors are asking us to thread the needle of what the narrative is that's priced. It's not intellectually coherent, and it hasn't been for a while.
That's great. It's not intellectually coherent. That's probably the best way I've heard to describe what's happening in the market, Lisa. So is that scenario worth records in tech? Is it worth close to a record in the S&P?
So look, as you know, we've been skeptical that the Mag 7, the focus on these high secular growth, very expensive stocks can continue in an environment where the economic growth is resilient, and therefore interest rates are stable as opposed to going down. And so what we've said to folks is it's very hard to continue to justify a market that's going to be levitated by expanding valuation multiples. So the only thing to get excited about are those companies that can really deliver the earnings growth, because you just shouldn't be betting that multiple expansion is going to get you there. Certainly not if you're betting on this economic soft landing where growth is okay, which means the Fed doesn't have to cut much and isn't going to give you much relief in terms of lower rates.
So, Zach, if growth is okay-ish, what do we do with the 2-year, 4.38%? What's it worth?
We still think it could go lower by year end in terms of yield. And really it comes down to, we do think that the Fed is going to be normalizing policy. Even if you have okay-ish growth, our forecast is something in the 1 to 1.5% range, which is below potential. And if you think about the progress that we've gotten on inflation already, that's with GDP growth well above what anyone expects potential to be. And so we think the Fed is in a position to start easing gradually, even if economic activity remains somewhat resilient, but certainly has to come off the boil that we saw in terms of the numbers in the middle of 2023. So we think that that creates a positive backdrop, certainly for corporate credit, but spreads have tightened in a ton already. So we're starting to think about how to re-rack looking forward, just given how much things have moved to start the year.
And we're like 3 weeks in, so that's a head scratcher for you. All right, Lisa, Zach, you guys are sticking with us. So joining us now, look at the stocks moving ahead of the opening bell. Here's Abigail Doolittle. Abigail?
Well, Alex, we do, of course, have U.S. futures pointing to an up open for a second potential up day in a row after 2 down days, and helping out to some degree, well, Ford is now flipping to to the downside. Earlier, it had been slightly higher, but initially on the news that they are cutting their F-150 Lightning production, not for the first time, the stock had plunged nearly 2%, then it flipped slightly higher, now a little bit lower. Investors, not that move one way or the other. Amazon up about 0.5%. Their proposed $1.4 billion buy of iRobot is expected to be blocked by the EU's antitrust body. The deal could be bad, according to this agency or people close to it, for other vacuum companies. And then take a look at Spirit Airlines. The saga goes on, Alex, up 26.5%. They are saying that they're fully behind the possible buy by JetBlue. Of course, it was blocked by a judge after the DOJ also said that it could be bad for consumers potentially. They're also talking about liquidity measures. They have not specified whether or not they will go through an appeal process, but I guess one would assume that is what they mean if they are still behind that deal.
Yeah, they're all for it. We don't know if that's actually going to mean anything. I wonder if we're going to see like meme stock trading with that spirit. All right, Abigail, thanks a lot. Coming up, Congress avoiding another shutdown for now.
Johnson wants things to go smoothly, and as you get closer and closer to November, you can imagine most of the GOP wants things to go smoothly as well, because they like being in the majority more than they like being in the minority.
And Ukraine aid and border security remain major sticking points. That conversation next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
People within the Republican Party, very conservative, who want to renegotiate that, who want to cut spending even further than that agreement. And the Democrats and President Biden are holding firm. A deal is a deal. We're sticking to those numbers for the rest of fiscal year 24. That will be the fight. Johnson wants things to go smoothly. And as you get closer and closer to November, you can imagine most of the GOP wants things to go smoothly as well, because they like being in the majority more than they like being in the minority.
Congress voting to approve a temporary funding package, averting a partial shutdown for the government until at least March, but not without a dose of drama. House Speaker Mike Johnson rebuffing a last-minute effort by ultra-conservative members of his party to leverage the deadline to pressure border policy changes. Johnson using alternative methods, stalling Ukraine aid in hopes of unlocking tougher immigration measures. Now, once Biden signs the legislation, two new deadlines loom, March 1st and 8th. Bloomberg's Kaylee Lyons joins us now with more. Kaylee, it gives a little breathing room, but I don't know, March 1st isn't that long way of a way. What's going to happen over the next few weeks?
Yeah, 7 weeks for Congress to try to figure out an appropriations process that to this point, Alex, 2 previous continuing resolutions did not buy them enough time to do. This is the third stopgap measure we have seen Congress pass because it is that difficult to reconcile the priorities of a Republican-controlled House and Democratic-controlled Senate and White House. But they're going to try once again to do this by early March. Keep in mind those 2 deadlines in between them, Super Tuesday and the State of the Union, a pretty rife political period. Also, by March, we'll be about halfway through almost this fiscal year that this budget is supposed to be addressing. So that's how broken this process is. And just speaking to the difficulty of getting these spending measures through this Congress, 108 members of the House voted against this yesterday, including many members of senior Republican leadership. They voted against Speaker Johnson on this, not just hardline conservatives who wanted to see border security measures included in this stopgap measure. This speaks to the difficulty of getting a border security and Ukraine deal through the House. Yes, Senate negotiators are working with the White House on that package. The Senate is aiming to potentially get that to a vote on the floor next week, but it could very well be dead on arrival in the other chamber, as representatives like Marjorie Taylor Greene are actually threatening a motion to vacate against Speaker Johnson if he brings a Senate-passed Ukraine bill to the House floor. So his job could be in jeopardy, but the pressure on him isn't even just coming only from inside the Capitol building. It's coming externally as well from former President Trump, who has said on social media in the last few days that the House should only accept a perfect deal on the border. And Trump and Johnson have a very close relationship. They talk frequently about this, and Trump may want the border issue to be a live one throughout the remainder of 2024 as he competes with Biden, theoretically, for the presidency come November.
All right, Kayleigh, thanks a lot. Working, although snow is falling in D.C., which is a really big deal in D.C. I just want to point that out.
Yes.
All right, Lisa and Zach are still with us as well. Okay, so overall what this does point out is there's still a lot of political risk, geopolitical risk, particularly as we head into the 2024 election cycle in November. Zach, do you need to hedge this right now?
Right now, it seems like a decent opportunity to consider the risks, just given, at least from a corporate credit perspective, things look pretty good. And when we think about the story of 2024, we think that there is a strong technical tailwind coming from perhaps money market fund cash coming out the duration and credit curves, but that's kind of overlaid with this rolling geopolitical and political uncertainty that we think is going to contribute to volatility. So you kind of have 2 clashing forces there. We think on net, things will proceed well, at least from a financial markets perspective, but we do think that the political overhang is only going to get worse from here.
Lisa, what do you think? I mean, typically in the equity market, if you try and hedge this kind of stuff, it like never works out. Brexit was the best bet. What do you do?
You said it, right? It never works out. And what we've observed, quite frankly, over the last 2 years is that markets have become even more insensitive to geopolitical events, to headline risk. I mean, we've had wars, we've had, various political headlines, threats of shutdowns. The market has continued to shrug it off. And, so what we're saying to our clients is, yes, this is a presidential year, presidential election year. It's also a year where there continues to be intensifying geopolitical stresses around the world. We need to be aware of them, but you cannot build a portfolio that way, trying to guess at the unguessable, because the market hasn't tended to price these things at all. Everything is looked through.
So to that point, Lisa, I'm wondering, when your clients ask about politics or geopolitics, what is their question?
Well, they always say, what's going to, the implication of this, red shirts, blue shirts on the market. We always dismiss that question immediately with the actual data that says it's irrelevant. We have good markets, bull, bear markets, regardless of who's in Washington. But what we do talk a lot about is policy. And what we've continued to say is let's focus on what are the policy implications. And there, it's not entirely clear. We have some headlines, right, that say, if one party, the incumbent party, wins, we may see a continuation of the fiscal spending and some of the programs that President Biden has put in place and a sustenance of those. Alternatively, if the House changes control or the White House changes control, we will likely have a making permanent of the 2017-2018 tax cuts. Both programs are likely going to be deficit sustaining as opposed to debt reducing.
Yeah.
And so we try to talk to folks about, look, right now, those are the only policies really that people can identify in terms of the differences, but the outcome's the same, which is both put upward pressure on interest rates.
Right. Yeah, exactly. So Zach, is that kind of how you talk to clients too? Like the big takeaway, no matter who wins, no matter what happens, no matter what geopolitics works out to be, is that we're gonna spend more money.
Well, that's kind of where I was going to go, Alex. In terms of the most underappreciated risk by the market, we think right now it's the possibility of higher rates again. I feel like it was a pretty brief trip to 5% on the 10-year, maybe more narrative-driven around the supply concerns that we have for this year. But those supply concerns, at least from a logistical perspective, that supply hasn't hit the market yet. And so that's something that we're concerned about. And I think all of these political issues, political headlines that we can expect just kind of highlight that dysfunction and brings back kind of the Fitch ratings downgrade that brought into question the U.S. government's credit rating. And so I think that's one thing that we are talking to clients about now and a way to position that is potentially duration hedges, especially if the Fed market pricing is way overdone kind of the way we think it is at this stage.
Did you anticipate, Zach, that you were going to see upward pressure on long-term rates, and also the Fed's going to have to be more active, maybe with hikes or at least not cuts, to manage any kind of deficit spending and inflationary impact?
I'd say we're concerned about the supply side of the story from a Treasury issuance perspective, and that's something that we're focused on. But when we think about what's going to overwhelm that, at least in terms of the shape of the curve and where rates go in 2024, it's going to be the monetary policy shift. And if you go back and look at Treasury supply concerns in the past, it's been more so the driver of yields in the shape of the curve has been these shifts in economic and monetary policy, not as much so the supply side. And so that empirically makes sense to us, but there are a lot of competing factors that we think will drive volatility in the meantime.
Guys, thanks a lot. Really appreciate it. Lisa Shallett, Zach Griffiths, appreciate your insight today. Coming up, you got the morning calls, and later Dan Suzuki of Richard Bernstein makes the case for repositioning he may not like tech. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down, right? So it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
All right, time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, you get Oppenheimer upgrading AT&T to outperform, citing several tailwinds, like including improvements to network capacity and coverage. Then you got Stifel upgrading DraftKings to buy, the analyst seeing near-term headwinds abating. Plus, Evercore ISI upgrading IBM to outperform, expecting the company to benefit from a host of AI-centric tailwinds this year. So coming up, we're going to follow that tech theme. Dan Suzuki of Richard Bernstein on why he sees a once-in-a-lifetime reason to reposition portfolios as we head into a market that's looking at big tech at a record and the S&P nearing a record as well, as we're just about 4 minutes away from the opening bell. Happy Friday, guys. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is the countdown to the open. Happy Friday. And if you had a playbook from the end of 2023, it is also a happy Friday. You're looking at NASDAQ 100 futures near a record. You're looking at the S&P futures near a record. And small caps are no slouch either, also up by 0.2%, but off the highs of the session. All right, let's switch up the board here as we get into the opening bell right there. You're looking at other asset classes. 10-year yield is just pretty much doing nothing, like maybe a little bit of pressure on the long end. The dollar, after a nice solid run over the last few days, taking a little bit of a break. And crude, modestly higher, but honestly, the action's not there. I hate to say it. It's not there. It's in the equity market. And lots of different stocks moving for many different reasons. And one is definitely Spirit Airlines. The carrier is saying it still plans to merge with JetBlue despite regulatory opposition. Abigail has more on that. Abby?
Yeah, this is an interesting one, Alex. And we do have the stock surging, heading to its best day right now since March 24th of 2020. This, of course, after after losing about 80% in the 5 days leading up to today, having to do with that federal judge siding with the Department of Justice, basically blocking that big deal with JetBlue. Today, the surge has to do with 3 reasons. You mentioned one of them. Another, they're also saying that bankruptcy is not an option right now after the setback for the JetBlue deal. Second, they're also exploring liquidity measures. In one in particular, they're saying that they're looking to refinance possibly some of their 2025 maturities on this. We have their junk bonds popping. And then third, that most interesting one, the idea that they're saying they're reaffirming the possible deal with JetBlue. They're saying that it, quote unquote, remains in full force in effect. This, of course, is intriguing because of that federal judge blocking the deal. It suggests that they are going to appeal. In a filing, they didn't mention the appeal, but what they did say is that they continue to believe that a combination with JetBlue is the best opportunity to increase much-needed competition and choice. So it almost is setting up an early strategy to argue the exact opposite of the Department of Justice, plus to calm investors. Now, the company and JetBlue are reviewing the court's decision and considering their next steps. The stock is down 80% over the last 5 days, and basically that is also the amount that it's down from when this deal was announced back in July of 2022, Alex.
I can't help thinking this is a Hail Mary from Spirit at the end of the day. All right, let's turn to EVs, because Ford is reducing production of its F-150 Lightning thanks to, guess it, fading demand. Ed Ludlow has more on that. Ed, I guess twofold question. Are you surprised by this? And sort of what took it so long?
Yeah, I mean, how I view this is Ford carrying out or acting on the outlook it gave last month, where it said it would cut production for the F-150 in half in 2024. What they are doing is cutting the specific workforce that is working on the F-150 battery electric pickup truck. It will impact about 1,400 jobs at the Rouge Electric Vehicle Center starting April 1st, when Ford plans to go down to just 1 shift at that facility. And as you said, the story here is that demand for electric vehicles continues to weaken. What Ford is saying is that it still expects growth overall in global EV sales in 2024, but that growth will be less than anticipated, and that outlook for growth was already depressed. And what I find interesting about this, as Ford is down a full percentage point at the open, is that they are actually boosting by 900 personnel those working on the combustion engine Bronco and Bronco Raptor SUV, Ranger Raptor pickup at the Michigan assembly plant. So taking from the EV workforce, adding to the combustion engine, and that kind of sums up where we're at right now with EV outlook in 2024.
Yeah, that truly is a perfect description of sort of where the industry is going to head in the short term. Ed, thanks a lot. All right, let's turn to chip makers now. You got TSMC's rosy 2024 outlook spurring a semiconductor rally and hopes of a broader tech recovery. This is now 2 days in the making. Alex Webb has more on that. Alex, what did TSMC do that really ignited this?
TSMC essentially said they're returning to the growth trajectory, at least partly, of previous years. Don't forget, last year they had a 4.5% revenue decline. There are 2 parts of their business that really matter here. There's the part that's exposed to smartphones and PCs. That's not been a terribly rosy industry over the past year or so. They also have, and they make the chips, I should add, for Apple in particular. The part that's really appealing right now is, of course, AI. They make the chips that are branded for NVIDIA, for AMD, that are fueling this AI computing explosion. The fact that they are forecasting 20% revenue growth for this year is, of course, good news for their own investors. It is also now dragging up a little bit AMD and, to a certain extent, Intel, which has great exposure to data centers. All these AI chips are going into these kind of data centers, so that's why we see these positive knock-on effects.
All right, Alex, thanks a lot. Really appreciate it. And finally, let's turn to retail. Macy's and Wayfair now announcing layoffs, as both are focusing on cost-cutting measures. Isabel Lee has more. Isabel?
Hey, Alex, it's a back-to-back layoff announcement, but you're seeing 2 very different reactions. Let's go to Macy's first. We have Macy's announcing a 3.5% cutting of its workforce. That's around 2,300 in their company, and mostly in corporate positions, and that comes ahead of the departure of their longtime CEO. The company is also closing around 5 stores. So it's been no secret that retailers, including Macy's, have been struggling as Americans shift their behavior from physical shopping to online shopping, and Macy's have posted annual revenue declines in the past year. So you can see the stock now down around 3%. Last year, it also ended the year lower by 2%. But Wayfair announced it's cutting 13% of its workforce. That's around 1,600 employees. This is the third restructuring, Alex, since the summer of 2022, and it's expected to save the company around $280 million. But you see that the stock is rising, so probably shareholders are looking at that as good news. Wayfair is up last year around 90%. So both these two aren't the only ones. Last year, we had Hasbro and Etsy announcing layoffs as well, so it just really speaks to the competitive landscape. And, of course, companies really trying to keep their margins up, Alex.
Yes, such a good point on the margin maintenance. All right, Isabel, thanks a lot. So Richard Bernstein's Dan Suzuki is optimistic for the year ahead. He writes this: when coupled with the prevailing bifurcation of sentiment and record market concentration, the current juncture may offer investors a once-in-a-generation opportunity to rebalance portfolios. And Dan joins us now. Dan, I'm so thrilled to talk to you. It has been so long since you and I have talked. It's good to see you. What's this once-in-a-generation moment that you're looking at here?
Yeah, Alex, it's great to see you. You need to fill in for John more often. Yeah, so I think that this is one of those once-in-a-generation opportunities. And, you know, we put out a report last week, and I basically looked at the best performing trades of the last 50 or 60 years. And, you know, the one thing that they have in common is, you know, they start out with huge skepticism and scarcity of capital, but by the end, the dominant fundamentals get so exciting that they become, you know, the only investment worth owning at the detriment of everything else. Mm-hmm. And so once you reach that point at which that's the only thing investors want to know, they'll pay any price to own it, you know, that sets up for a huge underperformance and a rotation into a leadership elsewhere in other markets. So, you know, you go back to as early as the 50s and 60s, you had the U.S. Nifty 50, you know, these huge blue chip, large cap stocks, which dominated their industries, had the best cash flows. That was the only thing you need to own. And then, you know, the multiples got crazy and it set up for 2 decades of underperformance for the U.S. Then you obviously had the tech and telecom stocks in the 90s. That's all you had to own with the internet wave. That didn't work out turned into the lost decade in the U.S. And then here, the last 15 years, we've had the rise of U.S. large cap growth and culminating with the rise of the Magnificent Seven. You know, again, these are the only stocks worth owning. That's usually a warning sign that the opportunities are probably elsewhere.
So I hear you, Dan. You could have made this argument, though, last July and also last December. So why is it the argument now with big tech?
Yeah, I think you can look at it from a couple different ways, Alex. I mean, one, from that long-term perspective, thinking about what the biggest trades are going to be over the next 10 years and what the worst trades will be. I mean, you've never before seen, you know, relative to all those other, you know, concentrated stories I mentioned, this one is actually more extreme from a concentration perspective and evaluation perspective. The U.S. has gone from 40% of the global stock market to something like 63, 64%. You know, the Mag 7 has gone from 7 to 30% of the U.S. And then on top of that, you know, the U.S., you know, trades at a record, you know, premium to the rest of the world, 60% more expensive than everywhere else in the world. So there's that long-term story. But I think the question you're really asking, Alex, is, you know, what's changed recently? And I think here it's really about the cyclical story. And I think that earnings, you know, a lot of people would disagree, is going to continue to accelerate, you know, as this recovery matures. But it's not going to be driven, you know, by these, you know, big growth sectors. Their earnings have been strong, but if you look at the earnings estimates, they're actually set to decelerate in the coming quarters. So what do you want to own? You know, the sectors that are going to drive that acceleration. I think that's going to be small caps. I think that's going to be industrials, energy, emerging markets even. I just don't think it's going to be these names, and that's going to lead to some potential disappointments.
So you make an interesting point about earnings growth for those cyclicals. On the flip side, though, that kind of earnings growth doesn't square with 7 rate cuts priced in from the Fed. So does that mean that you expect the Fed to not cut as much? And then does that then have a knock-on effect into how those cyclicals perform?
Yeah, actually, I don't know that the Fed is going to be a huge swing factor. I mean, obviously, it's what everybody wants to talk about. I don't think that the Fed's going to cut 5, 6, or 7 times this year. I don't think they're going to be anywhere close to that. I just don't know that that's going to have a big, you know, be a huge swing factor for markets. Ultimately, I think what's going to drive markets is going to be growth. And I think in the near term, growth is going to be better than expected. But as you get out to the second half of the year, I think the visibility is quite low. So you need to be on your toes and and look out for those signals that perhaps at some point growth is going to be rolling over. But to be clear, we're just not seeing any of those signs right now.
So then if you take a look at the rotation that you're expecting then from big tech to the cyclicals, what does that rotation wind up actually looking like?
Well, I think this is actually a pretty classic rotation, Alex. I mean, there's nothing necessarily that unique about this particular earnings recovery. You know, if you look throughout every earnings recovery, what happens is, you know, people, when earnings are terrible, are piling into the small and shrinking group of companies. They're able to continue to put up really strong growth. That continues to be the case, and why part of the reason why market leadership has been very narrow. But as growth broadens out and more companies can put up really strong earnings, you know, there's a natural, you know, the market becomes comparison shoppers. So why pay 30 times for the same growth that you can get for companies that trade at single-digit multiples? That's the sort of thinking that happens almost in every single earnings recovery.
So for the NASDAQ, though, for example, like, do we see like a bear market in this sort of scenario that you're looking at, or it's not that dramatic, it's just more about the cyclicals?
Yeah, I mean, I think eventually you are going to see a bear market. I mean, I've gone on so far as to say I think that this is a bubble, and I don't use that term lightly. So eventually that suggests that there's going to be a reckoning. I don't necessarily think that that has to happen in the near term. I think initially, you know, really the story could be underperformance as investors realize that there's other really attractive growth stories out there. I think maybe the next shoe to drop that really causes that potential downside for the sector is when things get really bad. Now, that could be 6 months from now, and that could be 2 years from now. But when growth really starts to roll over, I think people will be surprised, as they always seem to be, at how cyclical these companies' earnings are. Remember that if you go back a year ago, these companies that everybody have the best growth now, they were the ones leading us into the profits recession that we saw. So they are clearly cyclical. People just forget about that.
Totally fair. All right, Dan, you're going to stick with me. Dan Suzuki staying. Coming up, all eyes on earnings next week.
If you look at consensus estimates for this year, tech earnings are supposed to be up in double digits. Now, you know, maybe it's not going to be quite as high as that for the year, but I think double-digit earnings growth out of, say, a broad NASDAQ 100 index is I think, what investors essentially are counting on.
That conversation coming up next. As you look at a Friday, we're seeing a little bit of upside in stocks. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time, I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that. Maybe a more nerve-wracking place how that shakes out in cities. So yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
If you look at consensus estimates for this year, tech earnings are supposed to be up in double digits. Now, maybe it's not going to be quite as high as that for the year, but I think double-digit earnings growth out of, say, a broad NASDAQ 100 index is I think, what investors essentially are counting on. And so far, tech stocks have been able to deliver. So as long as we're in that range, it's better than about any other index can provide, and that's certainly why the enthusiasm is there, the flows are there, and also the valuations.
Earnings season kicking into high gear next week. Major airlines, a handful of consumer staples on deck. Abigail Doolittle is back with us for more. Abby?
Well, Alex, it's really pretty amazing because over the next 3 weeks, we will have nearly $30 trillion worth of market cap of companies reporting. Now, the bulk of that, of course, is big tech, and that's where a lot of the focus is, given their huge rally supporting these markets over the last year. But as you mentioned, lots of other companies reporting, including United Airlines. A big question there will be, will they follow in Delta's path and give a more conservative profit view than what will be expected? There's a chance that could happen. Higher wages could weigh on United's fourth quarter earnings as fares apparently are weakening and pushing their operating profit and margins lower. So stay tuned. D.R. Horton, the home builder, now their results will be a balance of looking forward and backward. Net new home orders may climb 37% in the first quarter versus the last year, but also it's going to include the look back in terms of the 8% mortgage. What influence will that have? Order results typically a leading, but because of that factor, we'll be looking backwards a little bit. Gross margins could be crimped by buyer incentives, but some analysts are saying December that the color there could be good. And then finally, we'll also have some of the consumer companies reporting, such as Clorox and P&G. P&G will see broad-based organic growth sales, apparently, according to analysts, across categories and regions. Will that happen again? An unchanged guide there would be very good. And then 3M, the conglomerate, they're looking to see their sales declines basically level out, plus potentially a positive update around litigation and more information on the earplug settlement. Stay tuned, Alex.
All right, Abby, thanks a lot. Hey, just to update everybody, we are seeing the S&P rolling over a bit, right around the lows of the session. Still in positive territory. The NASDAQ still at a record, but we are kind of rolling over here, and the VIX popping a little higher. Again, still negative, quote unquote, but we are seeing a little bit of pop. So just watch this as we head throughout the trading day. Let's turn to tech now. You got Netflix, Tesla, Intel, and more set to report next week. Ed Ludlow is back with us. Ed?
Yeah, good morning, Alex. I guess that Abby gave us a good setup, but look at the gains of the NASDAQ 100 and S&P 500 in 2023 and the outsized contribution to those gains, both from a stock index performance, but also a profit contribution from the Magnificent Seven. Luckily, we kind of start earnings in earnest next week, slowly. And if you're to draw some commonality, look particularly to the chip makers, Texas Instruments earlier in the week, Intel on Thursday. After we had that kind of outlook from TSMC 24 hours ago, what we will look is to the chip makers and ask, is there recovery in end markets, broad end markets, right from sort of more analog semiconductors that go into cars and consumer electronics right through to PC and data center. Tesla will be the big one, and the narrative around Tesla is that they have this target of 50% annual growth, but we're in a 2% environment. You saw the Ford news that we discussed earlier today, that growth in EV demand in 2024 be less than expected? Does Tesla maintain that 50% annual growth in that environment? And then beyond that, Netflix, I think there's a lot of confidence about Netflix that they finished 2023 strong. We have the writers and actors strike behind us. What does the content slate look like? But again, this kind of existential question of how do you be profitable in streaming will continue to be something that the street discusses in 2024. Then it's AI everything. And go back to December, our colleagues at the equities team in their Tech Watch column set it very clearly. The now expectation from the street is show us that AI is making a contribution to the bottom line. That will be the theme this earnings season.
Yep, straight up. All right, Ed, thanks a lot. Really appreciate it. So Dan Suzuki of Richard Bernstein is still with us. So Dan, that kind of put all stories together. Is it margin management? Like, is that the thing that's going to be their earnings season all about?
Yeah, I think it's really a tug of war right now, Alex. I mean, on one hand, you got margin management because you got pressures from labor costs, input costs, and interest costs. But then on the other hand, I think what you have is a lot of people are forgetting about is operating leverage. I mean, I think if you look at the last couple of quarters, what not a lot of people are talking about is you're finally starting to see top line sales growth accelerate, and that's what you really need to see in every earnings recovery. It starts with margin expansion through cost cutting, and then you have to pass the baton to operating leverage. I think that's what you're going to start to see. That's what's going to drive this next leg of earnings growth here, and that's why you want to own those companies that are going to see that operating leverage kick in.
Where do we see, though, what about consumer demand in terms of those kind of stocks? Like, we're all waiting for that to sort of fall out of bed. We saw Wayfair and Macy's doing some layoffs. What do you think we see there?
Yeah, I think that the market tends to swing in these huge has these huge pendulum swings in terms of the narrative, and it's usually not that extreme. So it's either the consumer is accelerating and booming and going to the moon, or it's falling off a cliff. And I think it's much less exciting of a story. My personal opinion is if you look at the drivers of consumption like labor and wages and overall economic growth, it's going to be gradually slowing here. And so I think it's normal to expect that to gradually slow, but clearly not fall off a cliff. I mean, you're seeing retail sales, as everybody cited, really strong. Their balance sheets are really strong. Interest rates are coming down. So there's no reason to think that they're going to collapse immediately. So I think that area of the market should be resilient. But we are, in my view, late in the economic cycle. I prefer late cycle plays, less, focus on the consumer.
Yeah, I'm not spending, Dan. I don't know if you know this, but I'm on a budget. It's a big deal. I'm definitely not spending, I promise. All right, Dan, thanks a lot. Dan Suzuki joining us. Really good to see you. Let's get some sector price action this morning and get to Bloomberg's Abigail Doolittle. Abby?
Well, after the last month, Alex, I'm not spending either. As for the sectors on the day, we have a small decline right now, gain for the S&P 500, but it is not a well-supported gain from a composition standpoint. Just 4 sectors are higher: communication services, tech, financials, and real estate to the downside, all the other sectors. So broad-based selling from a composition standpoint, but you have 2 of those sectors with big heavyweight weightings to the S&P 500, and the index is higher. Over the last 5 days, it's a similar story. We have just 2 sectors higher, tech and communication services, but big gains there. And for that reason, the S&P 500, I believe, is heading, yes, to just a small gain. And it's interesting also to the downside, real estate and utilities, those are the worst 2 sectors. Those are defensive sectors. So in some ways you could say that's risk on, but the fact that you have 9 sectors down, 2 up, I don't know, Alex, not great.
Yeah, it's looking a little messy there. All right, Abigail, thank you very much. Coming up, the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability.
And so they are looking at brands that are greener, but you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
But the superlatives are still count. The Nasdaq 100 at a record intraday and record close. The S&P at a record close right now, but intraday we're still about 10 points off. So now it's time for your trading diary. What you need to know about the day ahead and what we're watching throughout the rest of the week. UMISH, consumer sentiment, existing home sales coming at the top of the hour. Then check out Tuesday. We're going to get the BOJ rate decision plus Netflix reporting earnings, and tech earnings continue Wednesday. Tesla, IBM Thursday. ECB rate decision, and we'll also get U.S. GDP, and American Express reports earnings on Friday. We're just getting warmed up. This was the countdown to the open. Happy Snowy Friday, everybody. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries? Soft landing, hard landing, no landing? I don't know. True, what the heck does that mean? I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Well, are you confident? Some breaking economic news to discuss. After a record close for the tech-heavy NASDAQ 100, the inevitable question pops up. Is this a tech bubble? Have markets overpriced the speed and depth of Fed cuts? We're going to put that question to a bunch of market gurus today. This is Bloomberg Markets. Matt and Paul are all filling in. I'm John Tucker. Don't call him Barry. He's Bailey Lipschitz. No, that's Lipschultz. I knew that.
I know.
I'm just kidding you. Let's get a breakdown some of these numbers. We just got Bales from the University of Michigan. I'm going to call these Fed-friendly. Sentiment index much higher than expected, 78.8. The expectation was for 70.1. Maybe more importantly, the inflation expectations, the one-year inflation expectations, 2.9%. That is lower than expected, which makes it Fed-friendly. Very oftentimes, these are kind of self-fulfilling expectations. So anyway, let's get a deeper look at the markets right now. And to do that for us, here's Nathan Hager. In Washington, a snowy Washington, D.C., I might point out.
Gotten that snow yet in New York, John?
Yes, it is coming down right now.
Yeah.
The flakes are out there.
All day long. But at least it's Friday. And at least we're seeing a rally in this market. The Bloomberg Business Flash I got for you here. It's brought to you by Interactive Brokers. Interactive Brokers charges USD margin loan rates from 5.83 to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. We are on record watch for stocks. The number to beat for the S&P 500, 4796, set back in January of 2022. Right now, we're at 4795, a gain of 14 points for the S&P, up 0.3%. Dow Jones Industrial Average up 79 points, or 0.2% at 37,554. The NASDAQ 100 in record territory, adding to those gains, up 0.6%, up 103 points, 17,086. 10-year Treasury seeing a sell-off in bonds now, down 9/32 for a yield of 4.17%. Margie Patel, senior portfolio manager at Allspring Global Investments, says there's a disconnect between what stock and bond investors are focused on.
The equity market is looking at the strength of earnings. I think that's number one. And really, rates are so low across the board in treasuries, I would say it's almost irrelevant for corporate planning. And so many corporations raise so much money when we had zero interest rates that what the Fed does is really irrelevant to their operating.
And we're seeing some continued repricing of Fed rate cuts with the 10-year yield up 3 basis points. The policy-sensitive 2-year up 4 basis points at 4.39%. NYMEX crude's up 0.9%, up 70 cents at $74.78 per barrel. Checking Brent close to an 80 handle at 79.68. COMEX gold is up 0.5%, up $10 at $2,031.60 per ounce. The euro a little bit stronger against the dollar at 1.0884. British pound showing some weakness at 1.2679. And the yen is slightly weaker against the dollar at 148.26. Modest dollar weakness following that sentiment data from UMich. That's a Bloomberg Business Flash. Bloomberg Markets is on with John Tucker and Bailey Lipschultz.
All right, Nathan, thanks very much. Time now to take a peek under the hood, some of the stocks to move, companies to watch, and joining us now, Bloomberg Stocks reporter Nora Melinda. I was asking the question yesterday, are they toast, referring to Spirit Airlines?
I mean, it's been quite the journey, hasn't it? I mean, so Spirit Airlines shares were down 62% over the past 3 days, but we have a different story this morning on this lovely Friday. Those shares are on a roll, up as much as 28% for their biggest gain since November of 2020. And this is all after reaffirming its support for the JetBlue deal. They said that the deal remains in full force and effect, which has given investors a sense of...
Well, a judge says it isn't, right?
Yeah.
I mean, who cares what they say?
I mean, who cares what they say when we're hearing differing information? But This, nonetheless, has given investors a sense of relief after the court decision blocked the multi-million-dollar buyout earlier in the week. They have not specified whether or not they will appeal the ruling. They're still assessing their options to refinance 2025 debt maturities.
Well, I mean, when you look at that, we got positive data in terms of their 4Q revenue, but to JT's point, trades at $7, was at 15 3 days ago. So sure, a bounce from what was the low. 404 is nice, but still, the fundamentals.
When does that debt come due? That big.
They were talking 2025.
They were talking 2025 is when it's expected to mature. But as you mentioned, they are pointing toward that fourth quarter revenue reaching the high end of forecasts after strong bookings around Christmas and New Year's. But we'll see whether or not this could really pull the stock up far enough. As you said, it's trading pretty low, so very mixed views right now.
Looking at the debt briefly, that debt, 2025 debt, JT, trading around 52 cents on the dollar. Was it obviously 100, well, not obviously, but 100 cents on the dollar when the deal was announced, because when you get bought out, that kind of.
Okay, let's move on to the next one. And my question for you is, why is this so difficult? I would definitely buy, and Bailey would too, because he's from California, an electric vehicle.
I actually wouldn't, though. The charging stations.
Well, I mean,
if
that's
we
the problem.
figure that
Where do you
infrastructure out,
charge it? I've got range anxiety or whatever, and they're so darn expensive. And you would think the car companies who've been around for over 100 years would have figured it out.
We'll try to adjust, and it sounds, people are saying that there are going to be some hiccups along the way as we kind of gravitate toward EVs. But I'm looking at Ford this morning. It's down as much as 1.5% after saying it's planning to cut its production of its signature EV vehicle. It's a pickup truck. If you remember back in mid-December, Ford said that it was scaling back some of its 2024 production goals, cutting it in half, to place more of its focus on its signature F-150 Lightning pickup truck. But now it's changing its tune, saying that it's cutting all production of its signature EV pickup truck as waning demand impacts the EV space.
Well, we've talked about Cybertruck. This actually has a real truck bed, so it is a true truck.
Yeah, but it's like butt ugly.
But
it's that's my
not a fan.
It's not.
Have you seen it? It looks like, I don't know what it's like. McFly.
You gotta get a picture on the screen.
Right?
Well, no, I agree. And also, when I talk to people who drive trucks, the last thing they really want to do is shift to an EV just because they need the maximum hauling capability, I would think. Also, though, keep an eye on the fact that Ford, over the last 12 months, down 10%, so down 0.6% today, Nora, as you mentioned. Another one, though, deal news, iRobot, Amazon.
Yes,
What's going on with that?
Interesting here. So iRobot shares are down as much as 31% this morning for their lowest level since 2012 and biggest drop since 2018. This is all after expectations that the EU's antitrust regulator will block Amazon's proposed $1.4 billion acquisition of iRobot, which they're known for making the popular Roomba vacuum. I'm not sure if you guys have one, but I know a lot of people who do.
I don't even have a regular vacuum.
I don't have a snow shovel, so.
This guy, he buys a house in New Jersey, comes from what, Southern California?
From California.
And the first thing he does is goes out and buys a meat smoker at Home Depot.
He needs the shovel.
In a snowstorm. You know you need a shovel.
I know.
We need to educate you.
But would you rather have a smoked brisket or pulled pork?
I'd rather not kill myself in the driveway. And then you can enjoy your smoked brisket.
In a vacuum.
He's got his priorities all mixed up. Norma Linda, thank you very much. Appreciate it. Thanks for stopping by. All right, so at the top of the hour, Bales, we brought you the latest economic data. Another thing for investors to chew on, Bloomberg's Michael McKee taught me to follow the trends rather than the individual data points. So does consumer confidence, that's higher, at least according to the survey by the University of Michigan, and also the inflation expectations 1 year out, and then I didn't see the 5 year. What is that? The 5 to 10 year, that's also lower, at least lower than the expectations. Put it in the blender, and what is it? What do you pour out? What does it mean for everybody?
Since I walked in here, you've talked about barbecue. You've talked about
we do it all
blended
here.
Drinks. I'm hungry all of a sudden. This is all good news. It's maybe, if I were to hazard a guess, it's probably better news for Joe Biden than for the Fed and Jay Powell, because the Fed looks at these numbers and they like to see the consumer feeling better about things, and they hope that means they're going to spend more money. But there isn't a direct correlation between the two things. if the number gets down too low, you get into a kind of where recessions happen. But at this point, it doesn't look like there's anything like that's going to take place, because not only is consumer sentiment higher, but the index of household finances, whether people think they're better off than they were a year ago, went up significantly, better 40%. It was only 33% in December. So people are feeling better about their lives and about their money. And the reason it will maybe be good news for Joe Biden is they do ask by political party. And Democrats, 90.6 was the index for consumer sentiment in December, 101.3, an 11-point jump in January. And independents, who Biden would need to be reelected, 73.2 in January from 64.5. So some big jumps there. I'm not mentioning the Republicans, because the Republicans are still unhappy about the economy. 57.7 from 57.0. But it is always the case that the out party...
You don't have the answer to this. Why are they unhappy?
Because Joe Biden is president.
Oh, all right. So it doesn't matter.
It matters a little bit. Obviously, everybody's unhappy when inflation is high, inflation's coming down. Everybody's unhappy in a recession. But it's always the case that the party in power, their people tell these survey takers that they are happier than the others. It was a dramatic shift if you go back and chart it and look at what the by political party sentiment was when we went from Donald Trump to Joe Biden over that month period. Republicans were very happy and then unhappy, and Democrats were very unhappy and then they're happy. So it just maybe is a sign that some of the political polls might turn around. All those polls would say people are very unhappy with Joe Biden and the work he's done on the economy.
Well, you mentioned it being positive or Biden friendly. When we look at data and some of the trends that we're seeing, Fed friendly, does that correlate to market friendly? I'm just looking at the S&P 500 on the doorstep of a record high. It seems like earnings are in the forefront, but economics and what the Fed's doing is to rule us all.
It's an undercurrent in the sense that if you're investing in on the hope that earnings are going to go up and people are telling you they're happier and their incomes are higher, then you can sort of draw an inference that maybe they'll spend more money and that will help profits. You can't completely depend on it, and it's more of a contemporaneous thing than a forecast, but it does suggest that there's some good news out there in the whole thing.
Okay, I think it was Mike who taught us that the inflation expectations in this survey, they matter because there's sort of self-fulfilling prophecies. If you think inflation's coming down, you sort of change your behavior in some way. I don't know. Does that make any sense?
Well, in terms of deflation, if you think that prices are going to be cheaper tomorrow, then you stop buying because you're going to wait for prices to go down. And it's the same with inflation. It maybe pulls forward.
Well, I was thinking in terms of like asking for wage increases.
Well, if you think that you're going to have to pay more, if inflation is going up, then you're more likely to ask your boss for wage increases. And we did see that over the last 2 years, where average hourly earnings and wages and salaries kept going up because people were demanding more to keep up with what was happening with inflation. Now, inflation's leveled out, and that trend is starting to level out. So maybe we're through this without the kind of wage pull inflation that we saw in the 1970s and 80s.
Just looking at the data, 9.1 point increase on the biggest monthly advance since 2005. Is there something really to read into those types of size and scopes, or does it not matter as much?
It probably doesn't matter as much in the sense that, again, this is an index of sentiment as opposed to an actual index of money spent or something like that. It does suggest that something got through to people over the last month. I mean, maybe they had a great Christmas or something, but something happened that informed their view, made them feel better. It maybe they finally realized gas prices are going way down, or something like that, or food prices have leveled off, things like that.
Do you care a lot about, I'm going to call it existing home sales? Let's call it used home sales.
Used homes.
Coming in lighter than expectations.
It was only down 1%, and we're talking about 1,000 homes difference here. So at this point, it's not a big deal that it went down. We have seen in the last couple months a little more activity in the housing world. We haven't seen it yet reflected in the overall statistics, but as mortgage rates come down, you're seeing more mortgage applications. They've been up significantly the past 2 weeks, about 10% each week. So if that continues, then we should see home sales start to rise again. This is not a period where you're going to get a lot of home sales because it's the wintertime, but once we get to February and March, keep an eye out now that mortgage rates have come down some.
And when we look to the week ahead, obviously a big earnings week, but in terms of the economic data, what do you have top of mind? What do you think that Fed and market watchers are going to be paying the most attention to?
Well, there are two numbers that are going to get a lot of attention. One on Thursday is the GDP report. First look at fourth quarter GDP. Of course, the third quarter was very strong, around 5%. The estimate now by economists is for about 1.8, 1.9%. The Atlanta Fed GDP now is 2.4%. If we get anything around 2 or a little over, that would be considered very good news. We were expecting a big slowdown, but the consumer spending numbers we got this week suggest that we could get a pretty good report. If we see a disappointment, it's probably because inventories were worked down, which is bad for that quarter, but it suggests that strength ahead because we'll have to build inventories back up. Then on Friday, we get the PCE numbers, which will tell us more about spending because it includes services, which the retail sales doesn't except for restaurants. And we get the PCE inflation numbers, and those are important because that's what the Fed targets. PCE, they want a 2% headline rate. We're running at 2.6% now. It could go lower than that. And the core rate is at 3.4%. There's a feeling that could go below 3. And that would be a real market signal, make people in the markets feel much happier and think that the Fed is much more likely to cut rates.
All right, 30 seconds left. Are we headed in the right direction? Are all the trajectories that you look at headed down or lower or whatever you want?
Yes, for the most part. Everything is still positive. We're seeing a slowdown in economic activity to a certain extent, and we may see a slowdown in hiring and that sort of thing, but we're not seeing anything that you wouldn't expect given that the Fed has raised interest rates. And as long as inflation keeps going down, that's going to keep people happy. A lot of things out there in the news that could go wrong. I'm sure you know as you watch the news, but right now, you can't really say that things are going to turn pear-shaped.
Mike McKee, thank you. Appreciate it. I wanted to ask you why yields are higher, but we don't have time. 2-year yield, 5 basis points higher, 441. The 10-year is up 4 basis points, 418. As for stocks, the Dow right now, 62 points higher. This is Bloomberg. And that brings us to 10:18 on Wall Street. Let's get a look at company news now with Bloomberg's Steve Rappaport.
John, shares of Spirit Airlines are up more than 23% after the carrier announced it's not giving up on the merger with JetBlue. More from Bloomberg's Jeff Bellinger.
Steve, Spirit is trying to persuade JetBlue to appeal the government's decision to block the merger of the two carriers. Spirit indicates in a regulatory filing that it still believes in its plan to merge with JetBlue, saying it continues to believe a combination is the best opportunity to increase much-needed competition and choice. In the meantime, Spirit says it is taking steps to ensure the strength of its finances and ongoing operations in case it has to continue on its own. Steve?
Bloomberg's Jeff Bellinger. A tech giant makes an offer to appease antitrust regulators in Europe. More on that from Bloomberg's Sam Stolten.
Apple, the European Commission, announced today is seeking to potentially sidestep a hefty EU antitrust fine by filing commitments in an ongoing abuse of dominance case here in Brussels. Now, this case involves Apple's near-field communications chip. And what the European Commission says is that Apple actually restricts access to this chip to other rival mobile wallets.
That's Bloomberg's Sam Stolten. In other Apple news, pre-orders have finally begun for the Vision Pro mixed reality headset. John, I know you got $3,500 burning a hole in your pocket, so go shopping.
It looks so good on me, too.
Deliveries will, although pushed back to March 8th at the earliest. I'm Steve Rappaport, and this is Bloomberg.
stories, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's coming up to 10:22 on Wall Street. I'm Nathan Hager, watching a Friday morning rally. We got sentiment data from the University of Michigan. Consumer sentiment soaring to its highest since 2021, with short-term inflation expectations down to a 3-year low. We check the markets all day long on Bloomberg. Right now, the S&P 500 is up 14 points, or 0.3%, just shy of a record. The Dow Jones Industrial Average is up 93 points, or 0.25%. The NASDAQ 100 already in record territory, up another 96 points, or 0.6%. Lower Treasury volatility is helping tech shares this morning. And looking at the 10-year right now, it's now down 9/32 for a yield of 4.17%, a gain of about 3 basis points. NYMEX crude is up 1.1%, up 79 cents at $74.87 per barrel. COMEX gold is up 0.3%, or $5.70 at $2,027.30 per ounce. The euro, little changed against the dollar at 1.0875. British pound, 1.2664. The yen is at 148.42. Bitcoin down about 0.25%, trading around $41,000. That's a Bloomberg Business Flash. Bloomberg Markets continues with John Tucker and Bailey Lipschultz.
All right, Nathan Hager from a snowy Washington, D.C. So what's the state of the mysterious world of crypto now that you can jump in with an ETF? Sandy Call is head of digital asset and investor advisory services at Franklin Templeton. Our next guest, Gary Gensler kind of made it clear the regulatory approval of Bitcoin ETFs. That's no sort of implicit endorsement by the regulators. I imagine, though, that hasn't dampened any of the enthusiasm, has it?
No, it definitely has not. Record launch for an ETF. Over $3 billion in net new inflows into the products over the last just week.
And how do you view some of those inflows, though? I'm looking at Bloomberg data, BlackRock and Fidelity dominating in terms of flows, both north of $1 billion. I'm looking at least according to the terminal, Franklin Templeton closer to 50 million. So how does that play out?
Yeah, I think that it depends who your audience is out of the gate. Right now, you're seeing a lot of the direct, self-directed investors coming in and accessing this for their own personal portfolios. Moving these new products onto the wealth advisory platforms is going to take a few months as they do their due diligence, see how the new product works. And so there will be a slower buildup of assets in the discretionarily managed and in the professionally managed accounts. And I think you will see this continue to grow throughout the coming year. So kind of an out of the gate with the self-directed, and then over time you will start to see more of the advised assets having an allocation to Bitcoin in many of these portfolios.
What are your fees? Is there a fee war?
Well, our fees right now are 0, so I don't think you can beat that.
Well, you actually could, but I won't go into that.
Well, we believe that, we want these early investors who come alongside us in our new ETF offering to really get the 100% full benefit of movements in Bitcoin. We think we're coming up to an important period fundamentally in the Bitcoin market with the upcoming halving event, where the supply is going to tighten systematically. This happens through an algorithm, and it's coming right at a point where these new ETFs are creating demand in the marketplace. And we think it's going to be an exciting period for Bitcoin. So we want our investors to get the full benefit of any price movements that might result. And we're not taking any fee. We believe in the long-term nature of this opportunity, and we're willing to be in it for the long haul. So we're going to wait and take our fees later down the road as the product becomes more established.
I have a host of wacky questions. You guys have ESG offerings, I would imagine, right? Okay, so how does this conflict with that? Because in order to generate this stuff, you have to run computers which take gazillions of tons of electricity or gigawatts or whatever. That's sort of in direct conflict, I would imagine, with the environmental goals of the company.
Intuitively, it would seem to be, but what's been kind of very exciting about this is that a lot of clean energy launches have been held up because there has not been a clear use case for them. And what we're seeing is a lot of these Bitcoin miners that have relocated from Russia or from China are relocating into areas, and they are using clean energy incentives that are being offered by the government to build their mining facilities. So actually, it turns out that Bitcoin mining is starting to be a use case for introducing clean energy technology. And of course, not all Bitcoin miners are at that point, but we're seeing a very positive trend in this movement towards cleaner uses of energy for Bitcoin mining, which we think is a great thing to see.
And Sandy, you mentioned kind of taking the long-term view. Eric Valachunas, our Bloomberg intelligence analyst, coined it the Cointucky Derby, which I'm a big fan of. I enjoy betting on horses. JT, I don't know about you. No? Little pun for you?
Well, I'll go back to my wacky questions, but it's just like I go to the barber shop. That's topic du jour of people who can't afford to lose money and who don't know what they're talking about. I don't even know what a Bitcoin is. I can't explain it.
No, well, Sandy, I'm just wondering, the Cointucky Derby, use your pun, whatever pun you want. There are 9 new spot Bitcoin ETFs. How does the race for money impact kind of success and whether or not people are going to be pulling out of it?
Yeah, so I look at it this way. There's 2 sets of offerings that are coming to market through these 9, I think it's even 11. One set is coming from firms that have been digital natives and have kind of grown up in the crypto space. One set is coming from traditional asset management firms. I think Franklin Templeton is a little unique in that we're actually both, right? We have been active and operating in the digital crypto native space since 2017. We operating across 5 different public blockchains. We do our own node verification. We really understand and are a part of the ecosystem, create our own research on individual coins, including Bitcoin, and put together portfolios of multi-coin portfolios through separately managed accounts that we can work with investors to access. So we've been in this space for a long time and really understand it, yet we are also a 75-year-old asset manager who is trusted and who has been there for clients through many market regimes. So I think it's the coming together of the crypto natives and the traditional financial services, really epitomized by Franklin Templeton, that I think is creating the excitement about what's going to happen. And I don't know if it's going to be a derby and some aren't going to finish the race. I just think it's going to be a long race, right? It's a new asset class. Some of your questions are showing people have yet to kind of start to understand it. But once they do, I think it's hard not to get excited. I saw that in my own career. When I had my aha moment, it's like my eyes opened and I really saw this new opportunity and potential.
Sandy, this may be a dumb question. Bitcoin trades 24/7. If the token crashes on Saturday and Sunday, do I wake up Monday morning with a huge loss on my ETF?
Well, the good news for you is if the token crashes on a Saturday or Sunday, we've got portfolio managers and traders trading it on a Saturday and Sunday and working to keep the spread between the Bitcoin index and what's happening in the ETF in line. So we operate 24/7 in these markets, just like the markets operate. So it would be like any market. You know, if there's a move over the weekend, you'll see that move reflected. But the fact that the ETF is closed and the market is open isn't going to be a problem in this case because we're running a 24/7 trading desk around this.
You mentioned the next big step that includes derivatives with respect to Bitcoin.
That's a lot of people are looking already at derivatives. I think that, you know, building the education and understanding of the opportunity is more important as a next step than really thinking about the next product evolution. I think a lot of people have yet to really internalize. We've been in a period where we're used to platforms being the way of the economy. Network effects are built around platforms like Amazon or Uber or Airbnb. And now